Welcome back to the deep dive. We are doing something a little distinctive today. I want you to close your eyes for a second. Unless you are driving, please do not close your eyes if you are driving. And just imagine we have jumped slightly into the future.
Just a little bit.
Yeah, just a short hop. It is January 2026. The new year has just kicked off. The holiday decorations are finally coming down. And for anyone who is, obsessed with the macro picture, specifically where India fits into the global puzzle, this is the biggest week of the year.
It is indeed. It's the week the economic survey for 2025-26 drops. We are right in the thick of it.
Now, usually when I hear economic survey, I have a bit of a Pavlovian response. I expect like a 1,000-page doorstop.
The tone.
A tome of dry government prose printed on that really thin paper, and it's destined to sit on a shelf gathering dust until, I don't know, an academic decides to cite footnote 402.
That is the traditional reputation, yeah.
Yeah.
Dense, academic, filled with jargon that makes your eyes glaze over. Not exactly a page-turner for the morning commute.
But this time, we have got our hands on something else. We are looking at the highlights document that was released alongside the main survey. And it's this surprisingly sleek 45-page visual roadmap.
It's very different from what we're used to seeing.
It's absolutely crammed with charts, infographics, and what I really appreciate, minimal text. It feels like the finance ministry finally realized that in 2026, if you want people to understand the economy, you have to show, not just tell.
It is clearly designed to be accessible, which is a smart move. Whether you're a student, a policy nerd, a business owner, or just someone trying to figure out where to invest your savings, this document is trying to speak your language.
It really is.
But I will say this right off the bat. Do not let the colorful charts and the simplified graphics fool you. The data inside is signaling some profound structural shifts. This isn't just a marketing brochure. It is a status report on a massive machine.
And that is our mission for today. We are going to bypass the noise, the headlines, all of that. We are going to analyze this survey to understand the actual state of the Indian economy.
The real picture.
The real picture. We want to know where the money is coming from, where it is going, and crucially, where we are heading in FY27 and beyond. Because honestly, when I looked at the first few charts, I had this moment of, cognitive dissonance.
How so? What didn't fit for you?
Well, just look at the news, right? The global context. The world feels unstable. We keep hearing that trade wars are the new normal. We hear about security over efficiency. We hear about supply chains shattering.
All headwinds.
All massive headwinds. But then you look at this survey, and it is projecting Indian growth at nearly 7% in this climate. How does that math even work?
That is the central tension of this whole deep dive, isn't it? How do you sprint when the rest of the world is limping?
Exactly. So we're going to unpack this. There are 3 or 4 massive aha moments in here that I really want to get to. There is this concept of the Reform Express, which, okay, it sounds like a marketing slogan.
It does a bit, yeah.
But it actually explains the engine of growth in a really mechanical way. Then there is a massive flip in how the government earns its money. Spoiler alert, it is not how it used to be. And then there's this thing called GST 2.0.
Which is potentially a huge overhaul for manufacturing and really for the whole country.
So curiosity mode engaged. I saw these numbers and my first thought was just, okay, this looks good, but why is it happening?
And that is the right question. We need to be careful not to just get high on the headline numbers. We need to look under the hood. We need to look at the gears and the levers and the wiring. Because, as we are about to see, growing in 2026 is a very different ballgame than growing in, say, 2016. The rules of the game have changed completely.
Okay, so let's start with that context. The weather report, if you will. The survey has this section right at the top titled State of the Economy Pushing the Growth Frontier. And immediately it hits you with a pretty stark reality check about the global environment.
Yes. The very first takeaway is about a fundamental shift in the global mindset. If you think back to the last 30 years, the 90s, the 2000s, even the early 2010s, the global economy basically ran on one word: efficiency.
Right. You made things where it was cheapest. You moved money where the returns were highest. The world was flat. Just-in-time delivery was the gospel.
That was the entire playbook. You would design a phone in California, get the screen from Korea, the chip from Taiwan, the casing from China, and assemble it in Vietnam. All based on who could do each little piece the cheapest and the best.
Most efficient way.
The most efficient way. But that era, according to this survey, and frankly most observers, is effectively over. The survey explicitly states that global policy is now shaped by security and political considerations rather than efficiency or multilateral rules.
That is such a heavy phrase, security over efficiency. What does that look like in practice?
It changes everything. It means countries are putting up walls, both visible and invisible. They're asking questions they didn't ask before. Is this supply chain secure? Is this trading partner a long-term ally? What happens if a war breaks out 1,000 miles away? Will I still get my microchips?
So it's about resilience, not just cost.
Exactly. It's about de-risking.
Sure.
The survey lists specific stressors, export controls on technology. We have seen that with chips and AI, constantly in the newsphere's competition for critical minerals like lithium and cobalt for batteries, and just a general skepticism about free trade. The idea of a frictionless global market is, for now, a historical artifact.
And this is a very strong phrase that stood out to me, finance weaponization.
Yes, that is a potent term.
It sounds like something out of a techno thriller. What does that actually mean when it shows up in an economic survey?
It means using the financial system, the plumbing of the world economy, as a tool of geopolitical conflict. It's things like sanctions, freezing a country's foreign reserves, cutting off access to banking systems like SWIFT.
So it's not just about tariffs on goods anymore.
No, it's about stopping the flow of money itself. And when you weaponize finance, capital gets scared. It stops flowing freely across borders because investors and companies are afraid their money might get trapped or frozen if the political winds suddenly change. It introduces a massive new layer of risk.
So you have trade barriers, you have scared capital, and you have intensifying geopolitical conflicts. The survey is basically saying the global headwinds are more like gale force winds.
And amidst all that wind, there is a chart here that paints a pretty scary picture of the debt situation globally. It is titled Deteriorating Primary Balances.
I want to spend a minute on this because it's a dense chart, but I think it tells a huge story. It compares the UK, the USA, China, and India. But first, for the listener who isn't an accountant or a fiscal hawk, can we just define primary balance?
Sure. Think of it like your household checkbook. Your primary balance is your income minus your spending. But, and this is the key part, before you pay the interest on your credit card debt or your mortgage.
So it's just my day-to-day living expenses versus my salary.
Exactly. It tells you if you are living within your means on an operational basis. If your primary balance is negative, it means you are borrowing new money just to buy groceries and pay the light bill, let alone paying down your old debts.
Yeah.
You're digging the hole deeper just to exist.
Okay, that is a very helpful visualization. So looking at this chart, it tracks this balance from 2005 all the way to projections for 2025. And the lines for the US, UK, and China are, well, they're diving.
They are plunging. If you look at the U.S. and China specifically, their deficits are deepening significantly compared to their pre-pandemic averages. The chart shows the U.S. hovering in that -6% to 8% of GDP range. China is also trending downwards. This indicates that these major economies are running massive operational deficits. They are essentially keeping the lights on with borrowed money.
And the scary part is this is post-pandemic. This isn't the emergency spending anymore. This seems to be the new baseline.
That's the concern. The emergency spending seems to have become structural. They haven't been able to dial it back.
And then there's the line for India.
Right. India's trajectory is the complete inverse. After that big pandemic spike in deficit, which everyone had because governments had to spend to keep people alive and businesses afloat, India's line is trending sharply upward. It's moving back towards the zero line.
It's almost touching the zero line in the 2025 projection.
Exactly. It shows a tightening, a consolidation, a deliberate effort to get back to fiscal prudence. So while much of the developed world seems to be losing fiscal control, the survey is arguing that India is actively regaining it.
That is a stark contrast. It's like everyone else is putting huge charges on the credit card just to maintain their lifestyle, and India is, I don't know, eating at home and trying to pay off the balance.
That's a good analogy. And this matters because of something else mentioned in the report, rising sovereign yields. When the whole world is borrowing, especially giants like the U.S., the demand for money goes up. When demand for money goes up, the price of money, which is the interest rate, goes up for everybody, everywhere.
So money's just more expensive for everyone.
Correct. The cost of borrowing is high globally. So for India to be projected to grow at 6.8% to 7.2% in FY27 in that kind of environment.
That is the anomaly we were talking about.
It is. It really is. Growing that fast when global trade is fracturing and money is expensive is incredibly difficult. Most emerging markets get absolutely crushed in this kind of scenario. They get squeezed by high interest rates on their debt and falling demand for their exports.
It's like running a marathon at a sprint pace, but you are running directly into a stiff headwind, and maybe someone is throwing rocks at you for good measure.
A vivid image, but it's pretty accurate. And the survey attributes this resilience, this ability to keep running, to domestic drivers. Specifically, it points to private consumption and investment as the twin drivers.
Meaning the growth is coming from inside the house.
It has to. Because the world isn't buying as much, India has to rely on its own internal engine. People within India buying things and companies within India building things.
Speaking of engines, that leads us perfectly to the next big section. The survey literally uses the term Reform Express. I love it when economists try to get poetic.
They do try.
They say this Reform Express is pushing India's potential GDP to around 7%.
It is a useful metaphor, though.
Yeah.
It suggests momentum, and it suggests a vehicle that is built of specific, identifiable components. And they actually do that. They break down the engine into 3 distinct parts: capital accumulation, labor input, and total factor productivity.
Okay, let's deconstruct this engine then. If we want to understand why the economy is moving, we need to know what the pistons are doing. So, component 1, capital accumulation. To me, that just sounds like money.
It is money, but it is money turned into physical stuff. The source defines this as sustained capex, which is capital expenditure. It means building factories, roads, bridges, ports, data centers, the physical capacity to grow.
The hardware of the economy.
Precisely. But it also lists private investment revival and logistics reforms. This is crucial. It's not just about the government building a new highway.
Right. It's about a private company deciding to build a new plant next to that highway, because the logistics reform, like GST and the e-way bill system, means they can actually move their goods on that highway efficiently and cheaply.
Exactly. The two are linked. The public investment in infrastructure creates the conditions for private investment to follow. Think of capital accumulation as the chassis and the wheels of the car. You can't go anywhere if you don't have the physical structure, the roads, the ports, the machines. For a long, long time, India had a deficit here. The infrastructure just wasn't good enough to support sustained 7% growth. Trucks would get stuck at state borders for days, power would go out. This component of the Express argues that the chassis is now finally being built. The physical constraints are being removed one by one.
Okay, so we have the car, the physical structure, component 2 of the engine, labor input.
This is the fuel for the car. But it's not just about having a lot of people. Everyone knows India has a massive population, a huge demographic dividend. The survey is more specific. It points to greater formalization, implementation of labor codes, and skilling and employability.
Formalization is a key word here. We will definitely come back to that later when we talk about taxes, because it's a huge part of that story too. But in this context, what does it mean for growth?
It's about productivity. Imagine a guy selling vegetables on a handcart by the roadside. That is informal labor, it's hard work, it's honest work, but it has very low productivity. He can only sell so much, his reach is limited to who walks by, he's no access to credit.
Right.
Now imagine that same person getting a job in a modern food processing unit, or a large retail chain with a proper supply chain and logistics. His output per hour, his contribution to the gross value added, goes up dramatically.
Because he has systems around him, technology, management, a bigger market.
Exactly. Formalization is the process of moving millions of people from those low-productivity informal jobs into structured, higher-productivity formal roles. And the labor codes mentioned are a set of legal reforms designed to make it easier for companies to hire people formally without getting bogged down in dozens of archaic, complicated laws.
So if you take a worker and you give them better skills and a formal job environment, their individual output acts as a multiplier on growth. That is the labor input contribution.
Correct. It's about the quality of labor, not just the sheer quantity. It's about making your workforce more productive.
And then we get to the third component, the one with the fancy name, total factor productivity, or TFP.
This is the secret sauce.
Yeah.
This is the part that usually gets economists really excited.
Why? What is it? It sounds so abstract.
TFP is a measure of how smart you are working. It's the part of growth that you can't explain just by adding more capital or more labor. If you have the same amount of capital, the same number of machines, and the same amount of labor, the same number of people, but you manage to produce more stuff this year than last year, That increase is TFP.
How do you do that? Is it magic?
It's technology and efficiency. The survey lists the drivers: digital public infrastructure, regulatory simplification, and efficiency gains. Think about the India Stack UPI, Aadhaar, all of it.
Okay.
10 or 15 years ago, if a small business owner wanted to get a loan or make a payment to a supplier in another state, it might take days, even weeks. Paperwork, multiple bank visits, waiting for checks to clear. That is all friction. That is lost time, lost productivity.
And now that transaction happens with a QR code in 5 seconds.
In 5 seconds, for free. So that time saved.
Is productivity gained? That business owner can now spend that time selling their product or making their product, not standing in a bank queue.
That's TFP in action. Regulatory simplification does the same thing. If you cut the number of permits and licenses needed to open a new factory from 50 to 5, you get to production months, maybe even a year, faster. That is a massive TFP gain. It is the grease in the gears of the economy.
So TFP is basically doing more with what you already have just because you're smarter, faster, more efficient.
Exactly. And the expert insight here, the reason economists obsess over it, is that for a developing economy, TFP growth is the difference between getting stuck in the middle income trap and breaking through to become a truly developed economy. You can't just keep adding more people and more machines forever. Eventually, you have to get smarter about how you use them.
So the Reform Express has a chassis of capital, it's running on the fuel of skilled labor, and it has a high-tech navigation system called TFP. That makes sense. But is it actually working? The survey has a breakdown of broad-based growth.
It is. And broad-based is the operative word here. Often, in emerging markets, you see growth that is very lopsided. It's driven by just one sector, maybe a commodity boom or maybe just tech services. But look at the data in the survey for FY26.
I'm looking at the bar chart here. Services is the heavy lifter, which is not a surprise. It's projected at 7.2% to 7.3% growth. That is your IT sector, finance, hospitality, all the things India is known for.
Services has always been India's strong suit, the main pillar of the economy for decades. But look at industry.
Industry showing a really solid 6.2% to 6.4%, and agriculture is steady at around 4.5% to 4.6%.
That 6% plus in industry is crucial. That is the Make in India manufacturing push we have been hearing about for a decade, finally showing up consistently in the numbers. It means factories are actually humming. And that steady agriculture number is just as important. It means rural demand. The farmers out there buying motorcycles and soap and smartphones remains intact.
It's not just one part of the economy pulling all the weight.
Exactly. When all three pistons are firing: services, industry, and agriculture, the growth feels much more stable and resilient. It's less likely to be a bubble. It feels structural.
So we have a strong engine. It's running well despite the global storm. But engines, well, they cost money to run. And that brings us to the money part of the equation. Section 3, fiscal discipline. This really feels like the turnaround story of the whole survey.
It really is. And this is where we need to go back to that first chart we discussed about the deficits. We need to appreciate the sheer scale of the consolidation that has taken place.
The numbers are pretty staggering when you see them side by side. In FY21, which was the peak of the pandemic, the fiscal deficit was 9.2% of GDP. I mean, that is crisis level. That is, we are printing money just to survive level of spending.
It was, and arguably it was necessary. If the government hadn't stepped in with that level of spending, with free food grains, with support to businesses, the economy could have completely collapsed during the lockdowns. But the danger with crisis spending is that it's hard to stop. It's like getting addicted to painkillers. Many countries, as we saw with the US and UK data, have struggled to dial it back. The politics of cutting spending are always incredibly difficult.
But the survey shows India's fiscal deficit dropping all the way down to 4.4% in FY26 BE. That stands for budget estimates, by the way.
From 9.2% down to 4.4% in 5 years, that is a massive reduction. It's a halving of the deficit as a percentage of GDP. That requires immense discipline. You have to say no to a lot of new spending requests to hit a number like that.
And the primary deficit, which you explained earlier is the deficit without interest payments, that dropped from 5.7% to just 0.8%. That is practically zero.
It is essentially a balanced primary book. It means the government's tax revenue is, for the most part, covering all its spending except for the interest on old debt. You've stopped digging the hole deeper.
And the survey calls this anchoring stability. It sounds good, but this isn't just a pat on the back for the government, is it? It has real-world consequences for everyone listening.
Absolutely, because of the credit ratings, right?
Yes, exactly. The survey explicitly highlights that this prudent fiscal management led to sovereign credit rating upgrades in 2025. It lists Morningstar DBRS, S&P Global Ratings, and RNI Japan.
Okay, let me play devil's advocate for a second. For the listener who isn't a bond trader, who isn't checking Bloomberg terminals every morning, why should they care if Morningstar or S&P upgrades India's rating? How does that actually change their life?
It's a fair question. It feels very abstract.
It does, but it trickles down in a powerful way.
Mhm.
Think of the country like a person applying for a mortgage. If you have a bad credit score, the bank charges you a very high interest rate because you were considered risky. If you spend years improving your score, paying your bills on time, your interest rate drops significantly on your next loan.
Okay, that makes sense.
When a country's rating goes up, the risk premium on its debt drops. This lowers borrowing costs for the government. When the government, which is the biggest borrower in the economy, borrows cheaper, the benchmark interest rates in the entire economy often soften. This eventually, maybe not overnight, but eventually, trickles down to lower interest rates for corporations, so they can expand and hire, and for you, for your home loan or your car loan.
And I assume it also just frees up tax money that would have gone to interest payments?
Precisely. That's the most direct impact. If the government is paying, say, 0.5% less interest on trillions of rupees of debt, that frees up tens of thousands of crores that can be used to build roads, schools, or hospitals, instead of just being sent to bondholders. It's a virtuous cycle.
That makes perfect sense. But here's the part of the fiscal section that really surprised me. It's not just that the deficit is down, it's how they are filling that revenue gap. There has been a quiet revolution in where the government gets its cash.
The revenue revolution. This is one of the most structurally significant charts in the entire deck. If you are a student or a historian of the Indian economy, this is a chart you'll see in textbooks for the next 20 years. This is the turning point.
So let's look at the chart titled Sustained Revenue Buoyancy and Broadening of the Direct Tax Base. We are comparing the pre-pandemic average to the 2024-25 numbers.
And we're looking at the split between direct taxes and indirect taxes. Just to be clear, direct taxes are things like personal income tax and corporate tax. You pay them directly from your earnings or profits. Indirect taxes are things like GST, customs duties, taxes on petrol. You pay them when you buy something.
Okay. Pre-pandemic, the pie chart shows direct taxes were 52% of the total. Indirect was 48%. It was almost a 50-50 split.
A pretty even balance, which was the case for a very long time. And now,
In 2024-25, direct taxes have jumped to 59%. Indirect has dropped to 41%. That is a massive swing in just a few years. It's a near 60-40 split now.
it's a fundamental shift in the character of the tax system and, by extension, the economy itself.
And the data on tax returns explains exactly why. The number of income tax returns filed went from 6.9 crore or 69 million pre-pandemic to 9.2 crore, 92 million.
That is over 20 million new filers entering the system. This goes right back to that concept of formalization we discussed with the labor input. More people are getting formal jobs, more businesses are registering properly, their income is being tracked, and they are filing taxes. The system is capturing more of the economy.
So what does this all mean philosophically? Why is a shift from indirect to direct tax generally considered a good thing by economists?
Because direct tax is progressive,
Yeah.
it's based on the ability to pay. So the more you earn, the more you pay, both in absolute terms and often as a percentage. If you're poor and have no taxable income, you pay little to nothing in income tax.
And indirect tax.
Indirect tax is regressive. When you put a tax on a bar of soap or a liter of petrol, the poor person buying it pays the exact same amount of tax as the billionaire buying it. That tax eats up a much larger percentage of the poor person's income. By shifting the overall revenue burden more towards direct taxes, the system becomes fairer. It helps, at the margins, to reduce inequality in the tax structure.
It also feels like the economy is maturing. It's moving away from just taxing day-to-day consumption to taxing wealth creation and income generation.
Precisely. It is a sign of a modernizing state and a formalizing economy. And speaking of consumption taxes, we have to talk about the elephant in the room, GST.
GST, the goods and services tax. It feels like we've had it forever now, but it's still evolving. The survey shows robust transaction momentum.
It does. The bar charts show gross GST collections rising steadily year over year from FY23 to FY26. But interestingly, if you look closer, the rate of growth is stabilizing. It's now tracking nominal GDP growth.
Which means it's mature. It's not in that chaotic early phase anymore where nobody knew how to file and collections were jumping 30% a year. It's now a stable, predictable part of the revenue system. But the number in this section that really stood out to me was the e-way bills.
Ah, yes. The e-way bills, a fantastic data point.
115 core. That's 1.15 billion bills generated in just the first 9 months of FY26.
And it's still growing at 21% year on year.
Just to clarify for everyone, an e-way bill is basically a digital permit. You need to move goods on a truck above a certain value, right?
Correct. If goods are moving across state lines, or even within states in many cases, you need to generate this digital bill.
Yeah.
So this number is a direct real-time proxy for the physical movement of stuff. You can fudge a balance sheet, you can play with accounting, but it's very hard to fake 1.15 billion trucks moving goods on the highway.
So if e-way bills are up 21%, it means trucks are moving, factories are shipping, warehouses are stocking. It is the real-time pulse of the physical economy.
It confirms that the manufacturing and trade sectors are genuinely active. It's not just numbers on a screen. But the survey isn't just patting itself on the back for how current GST is working, it's teasing something new. GST 2.0.
This is the forward-looking part. This is what might be coming next. The survey outlines a proposal for a three-tier structure.
And this is a big deal for simplification, if it happens.
Right now, if you look at a GST receipt from a supermarket, it's a bit of a salad. You see 5%, 12%, 18%, 28%. Different items fall into different buckets, and it's quite complex. The proposal is to simplify it all down to just three rates: merit goods at 5%, standard goods at 18%, and demerit or sin goods at 40%.
And just to be clear, that 40% for the sin goods is inclusive of the cess that's already levied on many of them.
Right. So merit goods, I would assume things like essential food items, maybe some medicines, they stay at a low rate. Most things, your standard goods, fall into a single 18% slab. And then your sin goods, cigarettes, luxury cars, maybe aerated drinks, they get hit with that high 40% rate.
The stated logic here is consumption boost through simplified compliance. If you make the tax structure simpler, it's easier for small shops to comply, it's easier for buyers to understand, and it just reduces friction in the system. But there is a much deeper reason for this, especially for manufacturing. The survey specifically mentions resolving the inverted duty structure.
I saw that phrase. It sounds like confusing tax jargon. Can you explain that in plain English? What is an inverted duty structure, and why is it so bad for business?
Sure. Imagine you are a manufacturer who makes, say, toys. To make a plastic toy, you need to buy your raw materials. Plastic granules, electronic chips for the sound, maybe some specialty rubber for the wheels. Suppose the GST tax on those raw materials is high, let's say 18% or even 28%, but the tax on the finished toy that you sell is only 12%.
So I am paying more tax to buy the parts than I am charging in tax on the final product. That seems backward.
Exactly. It's inverted. So mathematically, you end up with a pile of input tax credit from the government. You paid the government 18 rupees on your inputs, but you only collected 12 rupees on your sales. The government owes you the 6 rupee difference. But getting that refund can be slow and bureaucratic. It means your money, your working capital, is stuck in the tax system.
That sounds like an absolute nightmare for a company's cash flow.
It is. It actively discourages value addition. In some cases, it makes it cheaper to just import the finished toy from another country than to make it here in India. GST 2.0 aims to fix this by aligning the rates. If most raw materials and most finished goods are all in that standard 18% slab, the manufacturer isn't penalized for making things in India.
So it directly makes Indian manufacturing more competitive on a global scale.
That is the claim. The specific phrase used is enhanced trade competitiveness. It's about clearing out the friction and the disincentives in the tax code so our factories can compete on a level playing field with those in Vietnam or China or Mexico.
Okay, so let's zoom out for a second. We are earning more money, and more fairly, from direct taxes. We are streamlining GST to make it simpler and better for manufacturing. The big question is, where is all this money going? What is it being spent on?
And we touched on this with the Reform Express, but the CapEx numbers really deserve their own spotlight. They are, in a word, huge.
CapEx, or capital expenditure, the good kind of spending, as economists like to say. Not subsidies, but assets.
Exactly. The survey shows the center's effective CapEx has scaled up from a pre-pandemic average of 2.7% of GDP to 4% of GDP in FY25.
That is a massive jump. 4% of GDP it's a colossal amount of money. We are talking about tens of billions of dollars.
It is immense, and this is going into railways, highways, defense production, energy infrastructure, digital infrastructure. The narrative here is very clear. The government is not just spending on subsidies or handouts, which is what we call revenue expenditure. It is spending on assets that create future value. A road built today creates economic value for 30 years. A port expanded today facilitates trade for a generation.
But here is the catch, and anyone who follows Indian politics knows this very well. India is a federal country. The central government sits in New Delhi and can have all these grand plans and spend all it wants, but if the states don't spend, the engine stalls. The
Yeah.
roads inside the cities, the local power grids, the water supply, that's all state subjects. And states are usually, let's say, cash-strapped.
Which brings us to one of the most interesting and, I think, underrated acronyms in the entire survey. SASCI.
SASCI. It's the Special Assistance to States for Capital Investment. It honestly sounds like a secret agent program from a movie.
It kind of acts like a stimulus injection. Basically, the center gives very long-term, interest-free loans to the state governments with one big string attached. The money must be used specifically for capital investment projects.
So the deal is, here's a huge pile of money. You don't have to pay any interest on it for 50 years, but you must use it to build something that lasts.
That's the deal. It's a pretty good carrot.
Yeah.
And the question is, does it work?
And the chart titled States Capital Outlay seems to answer that definitively. There are two lines on this chart. One is the actual spending by states, and one is what the spending would have been without the SASCI program.
It's a very clever use of a counterfactual.
It is. And the dotted red line, which is the projection without SASCI, it drops down to about 1.9% of GDP.
That would have been a significant decline. It means that left to their own devices, with their own strained budgets, states were actually pulling back on infrastructure spending.
But the solid green line, the actual spending with SASCI, stays up at a healthy 2.4%.
So the SASCI factor is literally the difference between states stalling their infrastructure build-out and states continuing to build. It's a prime example of what they call cooperative federalism. The center is using its stronger balance sheet to nudge, to incentivize the states to keep building, ensuring the reform express doesn't derail at the local level.
It's a very clever piece of fiscal engineering.
It is. It bridges that perennial gap between central government ambition and local government reality.
So if we take a step back, we have covered a massive amount of ground here. Let's try to synthesize this whole narrative for the listener.
Let's do it. It's a complex story, but there's a clear thread.
Okay, so we started with a world in chaos. A global environment defined by security over efficiency, finance weaponization, and rising debt in major economies.
A truly hostile environment for growth, especially for an emerging market.
And yet, in the face of all that, we saw India running into that headwind with a projected 7% growth engine. We deconstructed that engine, the Reform Express, and saw its three key components: capital, labor, and TFP.
And we saw that it was firing on all cylinders, including that crucial manufacturing component, leading to broad-based growth. And it was all powered by domestic consumption and investment, not fickle global demand.
Then we looked at the government's own books, and we saw a story of fiscal consolidation, reducing the deficit dramatically, which in turn earned better credit ratings from global agencies, making borrowing cheaper for the whole country.
And within that, we saw a structural shift in revenue earning more from progressive direct taxes on income than from regressive indirect taxes on consumption. This signals a formalizing, maturing economy.
High compliance, high growth. That seems to be the model.
That's the goal.
And finally, we saw where that money is going, not just being given away, but being poured back into the ground, literally through massive capex on infrastructure and using the clever SASCI program to make sure the states are building too.
That is the synthesis. It's a story of structural transformation. The survey is arguing that the Indian economy isn't just getting bigger, it's fundamentally changing shape. It is becoming more formal, more efficient, and more investment-led.
So here's where it's really interesting, the so what for our listener. What does this all mean for you?
The implications are both personal and professional. If you are in business, this trend towards formalization is undeniable. The net is widening. The days of running a large cash-only business under the radar are numbered. But in exchange for that compliance, the infrastructure to do business, the logistics, the tax structures, the digital payments is getting demonstrably better.
And if you are an investor, either here or looking at India from abroad,
The credit rating upgrades and the commitment to fiscal discipline suggest a new level of stability. It suggests that the currency and the bond markets should be less volatile than in many other emerging markets. In a chaotic world, the survey is positioning India as a potential safe harbor.
I have a final provocative thought for you to chew on, and for you, the listener, to take away from this.
Go on. I'm ready.
We talked at length about GST 2.0 and that big push for manufacturing competitiveness. We also started this whole conversation by talking about how global supply chains are breaking down because of these security considerations. Companies are actively looking for alternatives to China.
The China plus one strategy, as it's
Yeah.
called.
Exactly. For years, Make in India felt more like a slogan than a reality. People were, rightfully skeptical. But looking at the sum total of this survey, with these proposed simplified tax rates, that 5/1840 structure fixing that horrible inverted duty problem, when you combine that with this massive infrastructure build out we just discussed and the new labor codes,
Yes.
where are you going with this?
The question is this. Are we finally seeing the actual practical blueprint for India to replace those global supply chains? Not just talking about it, not just hoping for it, but actually creating the specific tax and logistics environment where it becomes mathematically the best option for a global company to set up their next factory here.
That is the trillion-dollar question, isn't it? The survey suggests that the hardware is being installed, the Reform Express has been built, and the tracks are being laid. Now we have to see if the software, the actual implementation of GST 2.0, the real on-the-ground enforcement of the labor codes, runs smoothly without glitches. If it does, then yes, we could be looking at the beginning of a decade where India becomes a primary factory to the world, simply because it's the only large, stable, and increasingly efficient place left to build one.
That is a massive thought to end on. We will certainly be watching very closely to see if that software loads correctly.
Indeed. The potential is clearly there. The execution is everything now.
And I highly encourage you, the listener, to go online and pull up this highlights document. We've described the charts, but when you actually see that visual divergence between the global debt line plunging downwards and India's consolidation line moving up, it really puts everything we've talked about into stark perspective. The devil and the delight is often in the details.
It is a visual roadmap worth exploring for yourself.
Thanks for diving in with us today. We will catch you on the next one.
At this stage, it becomes important to assess how these factors influence the economy as a whole.
It really is. That is the only lens that matters right now.
Right.
Because if you just look at the headlines, you get one story, and it's usually a noisy, often conflicting one. But if you look at the plumbing, you get a completely different and, frankly, much clearer picture.
Welcome back to the deep dive. And I have to be honest with you, today's stack of research is heavy. And I don't just mean heavy as in boring, I mean it's physically heavy. I feel like we've printed out half a rainforest for this one.
It's a lot to get through.
It is. We have banking data, trade charts, government schemes, insurance numbers, really detailed reports on digital infrastructure. And our mission today is pretty specific. We are effectively popping the hood on the entire Indian economic engine.
And that engine analogy is perfect here. It really is. Because usually when people talk about the economy, they just look at the speedometer.
Yeah, the headline number.
Exactly. They look at the GDP number, the stock market index, and they say, oh, we're going 100 miles an hour. Everything is great. Or, we slowed down to 60. Time to panic.
Right. It's all surface level stuff. But today, we are asking a completely different set of questions. Is that engine actually running smoothly?
Yeah.
Is the oil leaking? Are the gears grinding against each other? Or is this thing actually tuned up for a long-distance race?
Precisely. We are looking at the wiring of digital investments, the fuel lines of credit flow, and I think this is maybe the most important part, the armor the country is building against a very, very chaotic global environment.
And chaotic is the word for it.
Because let's be honest, the global trade environment right now, it isn't just tricky. In some ways, it is actively hostile.
Hostile is a strong word, but looking at some of these trade charts we'll get to later, I think it fits. There is definitely a storm brewing outside. But before we get to all the scary global stuff, I want to flag something right at the top because it genuinely shocked me. I consider myself a bit of a data nerd, but there's a stat in here about greenfield digital investment.
I know exactly the one you're talking about. It's the kind of number that makes you stop and, reread the page a couple of times.
It says India is currently outpacing the U.S. and China in this specific type of new investment. I mean, that felt like a typo when I first read it. Beating the U.S. and China in anything digital seems huge.
It's a headline in itself.
And then there's the banking data. We're talking about a cliff drop in bad loans that basically changes the physics of how money moves in the country.
It really does. If I had to put a bumper sticker on this entire deep dive, if I had to summarize this whole stack of paper into a single theme, it would be resilience and reorientation.
Okay, unpack that for me.
Well, it's a story about how fixing the messy stuff at home, creating real domestic stability, is now acting as a shield against that hostile world we just mentioned.
Okay, let's get into it. Because domestic stability sounds nice and comfortable, almost a little boring. But when you dig into the details here, it's actually, well, it's quite dramatic. Let's start with the money itself, the backbone of it all. Let's talk about the banks.
It's the only place to start because you can have the best factories, the smartest software engineers, the most brilliant entrepreneurs, but if the banking system is broken, none of that capital gets to where it needs to go. The economy just starves.
Okay, so I'm looking at the section here labeled monetary management. And immediately, I'll admit, my eyes are glazing over a little bit. We have terms like repo rate, reverse repo, and then this mouthful, the weighted average call rate, or WACR.
Right.
Do we really need to know what the WACR is? Or is this just economists speak for money?
Stick with me because this is actually the pulse of the entire system. If you want to know if the banking system is healthy, you look right here. Think of the repo rate, which is set by the central bank, the RBI, as the target temperature for the economy. The central bank says, we want the cost of money to be right here.
Okay, so the RBI sets the thermostat. They're saying it should be 20 degrees in this room.
Exactly. But just because you set the thermostat on the wall doesn't mean the room actually gets to that temperature.
Right.
Right.
Maybe the vents are blocked or a window is open.
Precisely. The WACR is the actual temperature in the room. It's the real rate at which banks are lending to each other overnight.
So if the WACR is different from the repo rate, it means the thermostat is broken, or the heating system is just busted.
Or the transmission, the ductwork, to use your analogy, is clogged. But here's the good news in the data. For FY26, and this is looking at data up to January 8, 2025, that WACR has been averaging about 8 basis points lower than the repo rate.
Okay, 8 basis points. That sounds tiny. That's what, 0.08%? Why should I care about such a small fraction?
You should care because of what it signals. It's a huge signal. When the actual market rate, the WACR, is consistently lower than the policy rate, it indicates that the system is flush with liquidity.
So there's cash sloshing around.
A lot of it. It means banks have cash. The pipes are not just clear, they are well greased. It means transmission. That flow from policy intention to actual market reality is working effectively.
So in plain English,
Yeah.
money's available, and it's moving easily through the system where it's supposed to go.
That's it in a nutshell. And that is a huge, huge shift from where we were just a few years ago when liquidity was often tight or that transmission was really laggy. It means if the central bank wants to ease conditions, the market actually feels it and feels it quickly.
It's got to be good news for anyone trying to get a loan, I assume. But here's where it gets really interesting for me. I'm looking at this next chart, the asset quality chart. And this visual is, well, it's wild.
The NPA chart, yes.
Right. I remember back in 2018, and that's not even that long ago, every single headline was about NPAs, non-performing assets, basically bad loans. It felt like every bank in India was sitting on this mountain of cash they had lent out to big infrastructure projects that went bust.
And they were never getting that money back. It was a genuine crisis.
It felt like it.
You aren't exaggerating. It was what economists called the twin balance sheet problem. You had corporations that were broke, so they couldn't pay the banks.
And then the banks were broke, so they couldn't lend to new companies.
It was a vicious cycle. In 2018, the gross non-performing assets, the GNPA ratio, was at 11.2%.
Let's just pause on that number for a second. 11.2%. That means for every 100 rupees a bank lent out, more than 11 of those rupees were effectively gone. Just stuck.
Stuck or gone, yes. That is a complete disaster for a financial system. If you are a bank manager in that environment, what do? What's your incentive?
You stop lending, you panic, you hide under your desk, and you just try to preserve whatever capital you have left.
Exactly. You become extremely risk-averse. You stop funding new factories or new businesses because you're too busy trying to plug the holes in your own sinking ship. And that causes a credit freeze across the whole economy.
But then you look at this chart, and the line for September 2025, it just falls off a cliff. It says the GNPA is down to 2.2%.
And even more importantly, the net NPAs, which is what's left after you account for the money banks have already set aside to cover those losses, are at 0.5%.
0.5%. That's basically zero. That's a rounding error in a system this big.
It is a multi-decade low. And we have to pause and just appreciate the scale of that cleanup. This isn't just some statistical quirk. This represents years of really rigorous recognition of bad assets, the implementation of the Insolvency and Bankruptcy Code, or IBC.
Which was a huge deal.
A massive deal, plus bank recapitalization and just fundamentally better lending practices.
So what does this all mean for the economy right now, today?
It means the banking sector's balance sheet is clean, It's strong. They aren't weighed down by the ghosts of past bad decisions anymore. So when a bank isn't panicked about its own survival or trying to cover up bad loans, it has the confidence to do its actual job.
Which is to lend.
It frees up capital for new growth. The engine hasn't just been running, it has been completely overhauled.
And we can actually see who they are lending to in this data, which I love. Because usually when banks get happy again, they just lend to the giant conglomerates, the super safe bets.
The ones who probably don't even need the money.
Exactly. But there's a chart here showing a really strong upward trend in bank credit to MSEs. That's micro and small enterprises.
Which is so crucial. If credit only flows to the top 1% of companies, the ones who probably have plenty of cash anyway, you get very skewed, very top-heavy growth. But when you see credit growth sustained in the micro and small enterprise sector, that's the real economy.
That's the local factory.
It's the local factory, the service provider, the small tech firm down the street. If they can access capital, the whole base of the economy expands. It's a much healthier kind of growth.
So the pipes are clear, the water is flowing, and it's actually reaching the smaller gardens, not just being dumped on the big industrial farms.
That is a very poetic and a very accurate way to put it. And it connects to this broader theme of financial safety. It's not just about banks lending, it's about how people and businesses are protecting themselves from risk.
Right, which leads us directly to the insurance sector. I feel like insurance is one of those things people just ignore until they desperately need it. But looking at these numbers, it seems like a lot more people are buying in.
The growth is really substantial. Look at the total premium income. In FY21, it was roughly 8.3 lakh crore rupees.
Okay.
By FY25, that number jumped to 11.9 lakh crore.
That's a huge jump in just 4 years. Is that just inflation or are people actually buying more coverage?
It's largely increased penetration. People are buying more coverage. As incomes rise, even modestly, people have more assets, a car, a house, their health that they want to protect. It signals a maturing economy.
How so?
Well, when you live hand to mouth, you just don't have the luxury of buying insurance. You're focused on today. When you start building even a small amount of wealth, you start thinking about tomorrow. You want to hedge your risk.
But here's the kicker with insurance, right? Paying the premiums is easy. It's getting the company to pay you when disaster strikes. That's usually where all the complaints start.
And that's a fair point. But look at the payout stats here. Life insurers paid benefits totaling 6.3 lakh crore rupees in FY25 alone.
6.3 lakh crore.
And in the non-life sector, so that's health, motor, things like that, net incurred claims were another 1.9 lakh crore.
That's a massive amount of money flowing back to families. It's not just a number on a page.
It represents financial shock absorption. That 6.3 lakh crore that went to families who lost a breadwinner or who hit a maturity date on a policy they've been paying into for 20 years. Instead of falling into poverty because of a crisis, that money acts as a stabilizer for them.
And the government seems to be trying to make this whole process smoother. I see a mention here of the Sabka Bima Sabki Raska Act, 2025. It's a very catchy name.
It is. But the substance is what really matters here. It focuses on simplifying the regulations and, importantly, aligning them with digital data protection laws.
So making it easier to file a claim online securely.
Exactly. The goal is to make the claims process less of a bureaucratic nightmare. If you simplify the rules, you increase trust. And at the end of the day, trust is the only thing insurance companies actually sell.
Speaking of trust and the little guy, I want to pivot to what might be my favorite part of this whole report. We talked about MSEs getting bank loans, but what about the people even smaller than that? I'm talking of the street vendors.
Yes. The unfunded initiative. This is where policy really hits the pavement.
Specifically, the PM Svanidhi scheme.
Yeah.
I love the story here because it feels so tangible. We're talking about microcredit for the street vendor who's selling tea or chat or vegetables from a push cart.
Yeah.
I mean, usually these folks are completely invisible to the formal banking system, right?
Historically, yes. Completely and utterly invisible. If a vegetable seller needed, say, 5,000 rupees to buy stock for the week, they couldn't just walk into a bank branch.
And the manager would laugh them out of the building.
It would. No collateral, no papers, no credit score, nothing.
So where did they go for that money?
They went to the local moneylender, and they would pay just exorbitant interest rates, sometimes 5% or 10% per month. It's a classic debt trap. They work 14 hours a day just to pay the interest on the money they borrowed to buy the vegetables in the first place.
It's basically modern-day feudalism. But the data here seems to flip that narrative completely on its head.
It really does. I mean, under the broader PMMY, that's the Pradhan Mantri Mudra Yojana, we've seen over 36.1 lakh crore rupees dispersed.
That's a huge number.
It is, but look at how it's spread out. It's across more than 55 crore loan accounts. 55 crore. The sheer scale of that inclusion is just staggering.
But let's zoom in on PMS Vinizi specifically, because that's the one for the street vendors. The impact assessment here is fascinating. It says the average annualized business income for borrowers increased by 20% between 2023 and 2025.
Now think about that for a second. A 20% income bump. For a corporate employee, that's a great year. For a street vendor operating on razor-thin margins, that is life-changing.
It's the difference between just getting by and actually saving.
It's the difference between pulling your kid out of school to work or keeping them in school. It's monumental.
And the report actually backs that up with more detail. It's not just money in the pocket. It's about where that money goes. The data shows 39% of these households upgraded their housing. 55% got better access to food. 50% enhanced their educational opportunities.
This is the multiplier effect in action. It's a perfect example. You give a small loan, just working capital, to a vendor. They buy more stock, they sell more, they earn more. With that extra income, they fix their roof so the local carpenter gets paid. They send a kid to a better school, which is investing in human capital. The loan doesn't just sit there, it ripples through the entire community.
And look at who is getting these loans. This is also incredible. 43% of beneficiaries are women. Oh, wait, let me just check the fine print here. Actually, looking closer, under the broader PMMY scheme, women entrepreneurs accessed 69% of all the microloans. That is massive.
It is. 69%. And specifically for S-Venity, the street vendor one, 33% are women and 64% belong to OBCs, SCs, and STs. It is targeting exactly the demographics that have historically been excluded from any kind of financial power.
But here is where the cynic in me, or maybe just the traditional banker in me, has to ask the hard question. It all sounds great, but are they paying it back? Or is this just charity disguised as lending? Because giving unsecured loans to people with no credit history sounds like a subprime crisis just waiting to happen.
And that's the fair question to ask. But here's where it gets really, really interesting. Conventional banking wisdom has always said that lending to the poor is high risk.
Right, that's banking 101.
But the NTA rate for these S-Venity loans is below 10%.
Below 10%.
For that demographic.
Yes, and that shows incredible repayment discipline at the bottom of the pyramid. It proves that if you provide access to capital on fair terms, not predatory terms, people will honor that obligation. They value that lifeline because they know how hard it is to get money anywhere else. They don't want to burn that bridge. That is a really powerful point. It validates the whole model. It's not charity. It's actually viable banking.
Yeah.
Okay, so moving up from the street level to the high rises. Let's start with the stock market, the capital markets.
A very different world, but it's undergoing a very similar kind of transformation.
It feels like the market has been on a tear for a while now, but is it just speculation? Is it just, people gambling on apps on their phones?
The data here suggests it's more structural growth, not just a casino. Look at the primary markets. That's where companies actually raise money to grow their business. The total resource mobilization equity plus debt was 218.3 thousand crore rupees in FY25.
And the number of IPOs. It says here the number of initial public offers jumped from 164 in FY23 to 320 in FY25. That is almost double in 2 years.
It is. And it reflects a really vibrant entrepreneurial ecosystem. An IPO is a huge step for a company. It means you're confident enough to open your books to the entire world, and investors are confident enough to back your vision. When you have 320 companies doing that in a single year, it shows a lot of underlying energy and optimism.
But my favorite part of this whole section isn't the money. It's the paperwork. Or, I guess, the lack of it.
The regulatory cleanup.
Yes. It says the RBI consolidated over 9,000 existing circulars. Can you just imagine that bonfire? 9,000 circulars. I just picture a room full of bureaucrats shedding a tear as they shred decades and decades of rules.
It does sound like a spring cleaning on a massive scale. But jokes aside, this is absolutely crucial for the ease of doing business. If a bank or a fintech company has to navigate 9,000 different rules, circulars, and amendments just to launch a new product, they simply won't do it.
Or they'll do it very, very slowly.
And very expensively. Consolidating all of that into a manageable, modern framework reduces friction. It saves time, it saves money, and it saves a lot of legal fees.
And it's not just about deleting old files, they're adding new high-tech rules. I see something here called free AI.
Yes, that's the RBI's new framework for using artificial intelligence in finance.
Free AI. I'm going to assume that doesn't mean the artificial intelligence is free of charge.
No, sadly not. It's an acronym for the framework's principles. But the main point is the regulators know that AI is coming to banking. It's already here for fraud detection, for customer service, for credit analysis. Instead of banning it or just ignoring it and letting it become a Wild West, they are creating a structured approach to leverage it while managing the risks involved.
It's proactive regulation, which you don't see very often. And then there's this, the Securities Markets Code 2025.
Which is a huge legislative achievement. It basically takes a whole bunch of old acts, the SCRA from 1956, the SEBI Act from 1992, the Depositories Act, and rolls them all into a single modern framework.
So the same principle as the circulars.
Exactly. It's about modernizing the rules of the game to match the speed of the modern economy. You simply cannot regulate high-frequency algorithmic trading with a rulebook that was written in 1956.
So if I were to sum up the entire domestic side of the story so far, we have clean banks, a financial safety net that's actually catching people, a microloan system that's empowering the smallest entrepreneurs, and a stock market that's running on modern software instead of dusty paper files. Domestically, the house looks pretty tidy.
Which is extremely fortunate because if we look at the window, the weather outside is getting very, very stormy.
This brings us to the external sector. And looking at these charts, stormy feels like a bit of an understatement.
It is a profoundly challenging environment. I want to direct your attention to this one chart, the Trade Policy Activity Index.
That sounds incredibly dry, I have to say, but the chart itself is alarming. It looks like a heartbeat monitor that just spikes through the roof.
It is. It tracks trade restrictive measures versus trade facilitating measures. So basically, our country is making it harder or easier to trade with each other. And in CY 2025, we see this massive, sharp spike in restrictive measures.
So we're talking about tariffs, bans, extra paperwork, sanctions, all of that.
All of it. Global trade is fragmenting. Geopolitics is interfering with economics in a way we haven't seen in decades. Supply chains are being rerouted not because of efficiency, but because of suspicion and national security concerns.
And this uncertainty hits economies like India's harder.
Much harder. It hits emerging markets, what they call EMDEs, much harder than the advanced economies. They're more vulnerable to these kinds of shocks.
So in this global bar fight, how is India doing? Because we are still a developing economy. We need to trade to grow. I'm looking at the scoreboard here for April to December 2025.
Let's look at the numbers. They tell a mixed story, but a fascinating one.
Okay, so merchandise, that's physical stuff, right? Goods, cars, clothes, oil. Exports were $330.3 billion, but imports were $578.6 billion. That leaves a pretty big hole. A deficit of $248.3 billion.
That is the merchandise deficit. We buy more oil, electronics, and machinery than we sell in terms of physical goods. And that's been a historical trend for India. We are an energy-hungry nation, and we are still in the process of building our manufacturing base.
That number still worries me, though. $238 billion is a lot of money leaving the country.
It is, but then you look at the next line item, and you see the secret weapon, services.
The invisible shield.
What's absolutely fascinating here is the sheer power of the services engine. Look at the services exports number.
$304.0 billion. And the surplus, the profit, essentially is $152.2 billion.
That is the buffer. That is the shock absorber. We have a massive surplus in services, IT, consulting, digital delivery, GCCs. And when you combine that with remittances from Indians working abroad, it goes a long way to offsetting that merchandise deficit.
So to simplify it way down, we buy gadgets and oil from the world, which costs us a lot of money, but we sell code, consulting, and brain power back to them, which makes us a lot of money.
Essentially, yes. The digital economy is effectively subsidizing the physical economy's import needs. And because of that powerful service engine, the overall current account deficit, the CAD, is surprisingly manageable. It moderated down to just 0.8% of GDP in the first half of FY26.
0.8% sounds very safe.
It is very safe. It's a very comfortable number, especially in such a volatile world. It means we aren't borrowing heavily from the rest of the world just to pay our daily bills. We are more or less paying our own way.
You're talking about selling code and digital services. That segues perfectly into what might be the most surprising chart in this entire stack of paper. We mentioned in the intro, segment 5. the digital investment boom.
This is a standout metric. This is the one that really turns heads in boardrooms in New York and London and Tokyo.
I had to read this twice to make sure I wasn't misreading it. It says that between 2020 and 2024, India was the largest destination for greenfield digital investment globally.
Yes, attracting some $114 billion.
And just to be absolutely clear, that puts India ahead of the United States, China, and the UK.
In this specific metric of greenfield digital investment, yes. Head of everyone.
Okay, I have two questions then. First, for anyone listening who might not know, what exactly is greenfield investment? And second, why is everyone suddenly parking their money here?
Great questions. So first, greenfield means you're building something completely new from scratch. It's not just buying a stake in an existing Indian company. That's called a brownfield investment. Greenfield means a foreign company comes in, they buy land, they build a brand new data center, they set up a new development hub, or they lay new fiber optic cables. It represents new capacity being built.
So it's a long-term bet. You don't build a massive data center if you're planning to pack up and leave in 6 months. It's sticking a flag in the ground and saying, we're building here for the future.
Precisely. It's a huge vote of confidence in the future infrastructure of the country. And to your second question, why India? It connects directly back to that global FDI reorientation we discussed earlier.
The whole supply chain shifting thing,
Yeah.
the China plus one strategy everyone talks about.
Yeah. Yes, that's a big part of it. As companies look to diversify their operations away from China or other geopolitical hotspots, they need a base that has scale, stability, and critically, a deep pool of digital talent. India is ticking all of those boxes right now. We are seeing these huge investments in digital services, in data centers, and in core IT infrastructure.
The report also mentions strategic sectors like semiconductors getting a lot of attention.
That's the next frontier. We are seeing gross FDI inflows remain very high, projected around $64.7 billion for FY26. Now, there is also repatriation money going back out, which is a natural part of the cycle as early investors take their profits.
Sure.
But the net FDI, the money that is staying here to build capacity, is increasingly focused on these high-growth strategic areas.
It really feels like India is trying to position itself not just as the digital back office of the world anymore, but as the digital front office too.
That is absolutely the ambition. But to secure that position, you need partners. You can't do it all alone, especially when the rest of the world is busy putting up walls. Which brings us to the diplomatic side of things.
The free trade agreements, the FTAs.
Right. Remember that trade policy activity index we talked about, the one that showed everyone is becoming more restrictive?
In the global bar fight where everyone is locking their doors.
Exactly. So if everyone is locking their main doors, the smart strategy is to go around to the side and sign VIP entry passes with specific friends. You create your own exclusive club.
I like that analogy. So who are the new VIP friends? Who is in India's club?
The list has been growing steadily over the last 5 years. We've had agreements with Mauritius, the UAE, Australia. That Australia ECTA was a very big one.
And what about the new additions for 2025?
We're looking at the India-Oman CEPA, the India-New Zealand FTA, and the India-UK CETA. Plus, the big one with the European bloc, the India-EFTA agreement.
That is a lot of acronyms. But fundamentally, what does signing all these deals give us?
Market access. Plain and simple. It guarantees that our exporters, whether they're selling textiles, gems, or software, have a predictable set of rules and lower tariffs when dealing with these key partners. It's basically an insurance policy against rising global protectionism.
So while other countries are slapping tariffs on everyone, India is building these specific bridges with strategic partners to keep goods and services moving.
It's smart. It's like building your own custom trade network while the big global WTO network is, glitching out.
It's very pragmatic.
It is.
So we've covered the offense, the digital investments, the trade deals, the credit growth. But what about defense? What happens if something really bad happens on a global scale? Another pandemic, a bigger war, a major financial crash. I mean, we've all seen how fragile things can be.
That is the ultimate test of an economy's resilience. It's about its buffers. How much of a shock can you actually absorb before you break? And this is where the comparison between a decade ago and today is the most striking.
Okay, let's look at the report card then. Let's compare FY15 with FY2526, a 10-year gap.
In FY15, our Forex reserves were around $341.6 billion, which was respectable, but not invincible. During the taper tantrum a few years prior to that, we saw how quickly those reserves can drain away when global sentiment turns.
And today, or rather as of January 2026.
$701.4 billion.
Wow. So we've more than doubled the national savings account.
We have, and that is a massive war chest. But the raw number itself matters less than what it can buy you. Look at the import cover metric.
Explain that one for us.
Import cover tells you, if every single dollar of your export income stopped tomorrow, if we sold absolutely nothing to the world, how many months could we keep buying our essential imports like oil, gas, and medicine using only our savings?
Okay, so it's the survival timeline.
It's exactly that. In FY15, that timeline was 8.9 months. Today, it's 11.1 months, almost a full year of breathing room.
That is a massive strategic advantage. It means India doesn't have to panic the moment oil prices spike or currencies start fluctuating wildly. We can sit tight and wait it out.
It gives policymakers independence. They don't have to go begging to the IMF or other nations the moment there's a global hiccup. It's a cushion.
And what about debt? Because usually you build up big reserves by borrowing a lot of money.
Not in this case. The external debt to GDP ratio has actually dropped. It's down to 19.2% as of September 2025. So we have more cash in the bank and less debt relative to the size of our economy.
So if we connect this to the bigger picture, what's the takeaway?
The takeaway is that we enter 2026 with what I would call a fortress balance sheet. The global economy is rocky. We see trade wars, we see conflict, we see this fragmentation. But India has systematically built up its shock absorbers. We have high reserves, low external debt, and a banking system that is healthier than it has been in decades.
It's a reassuring thought. We aren't just crossing our fingers and hoping for the best. It seems we've actually bought the insurance and reinforced the hull of the ship.
Exactly. It's about preparedness over hope.
So let's bring it all home. We've been on quite a journey through this mountain of paper. My brain is full, but in a good way.
We have covered a lot of ground, no doubt about it.
We've seen a banking sector that's scrubbed itself, clean dropping those bad loans, the NPAs, from over 11% down to near 2%, and it's finally fueling the small guys, the MSEs. We've seen street vendors upgrading their houses and sending their kids to school because they finally got access to fair credit through schemes like S-Vanity.
A huge impact at the ground level.
And we've seen a world-beating surge in digital infrastructure investment where we're actually outpacing the giants and a government that's frantically signing trade deals to keep markets open for business.
And we've seen that all of this is backed by this massive war chest of over $700 billion in Forex reserves. It's a story of refining the regulatory touch, making things easier to do internally while simultaneously building internal strength to weather those external storms.
It sounds almost too good. Is there a catch? I feel like we need to end on a bit of a reality check here.
Well, there is always a challenge. Progress solves old problems, but it almost always creates new questions. And this entire report, I think, raises an incredibly important question for the next decade.
Go on. Give us the cliffhanger.
We see this massive world-leading investment in digital infrastructure. We see our services sector carrying the entire trade balance on its back. We are undeniably a services superpower. But, as we saw in the numbers, we still run that huge $248 billion deficit on physical goods. We still import a lot of stuff.
Right. You can't email a car or download a barrel of oil.
Exactly. So the big question, the one for the listener to really mull over is this. Can India translate this digital dominance into a manufacturing revolution that finally closes that goods deficit? Can we use the digital engine to jumpstart the factory engine? Or, as global trade restrictions continue to rise and the world potentially splits into competing blocks, will we run out of time to become that manufacturing giant?
That is the trillion-dollar question, isn't it? Can we make the things as well as we code the software? That's something to think about. Thanks for taking the deep dive with us.
Always a pleasure. At this stage, it becomes important to assess how these factors influence the economy as a whole. Because let's be honest, when we talk about the economy, it's incredibly easy to get lost in the noise.
Oh, absolutely.
We get obsessed with the daily stock market tickers, the political shouting matches on cable news, or, the latest tech IPO that everyone is tweeting about.
Right. The shiny objects.
Exactly. But today we are zooming out. We are looking at the absolute bedrock of the Indian economy. Prices, food, and the massive structural changes happening in the life of the Indian farmer.
That's right. And to do that, we aren't just relying on vibes or anecdotes. We have a stack of fascinating data in front of us, specifically the latest economic survey data covering the period through the end of 2025.
And we are looking at numbers that, quite frankly, defy recent history.
Defying history is a good way to put it.
It's more than that. I looked at the headline number this morning and I honestly thought it was a typo. No, seriously, I had to refresh the page, check another source, and then go back to the original report just to be sure.
It definitely catches you off guard if you haven't been tracking the monthly shifts very, very closely.
It really does. So let's not bury the lead here. We have a big reveal. Here is the headline statistic that anchors everything we are going to talk about today.
Let's hear it.
India has recorded the lowest inflation rate since the beginning of the current price index series. We are talking about the average from April to December 2025.
It is a historic low. We are in uncharted territory for this specific metric.
The number is 1.7%.
That is wild. Just let that sink in for a second. For an economy that has spent the last decade, maybe more, wrestling with price volatility.
Oh, constantly.
Where every other month we're panicking about the price of onions or fuel or milk anchoring headline inflation at 1.7% is a massive deviation from the norm. It feels almost too quiet. It is quiet. And context is everything here. Because usually when you see a number that low, your first instinct is to ask, okay, is the whole world cooling down?
Yeah.
Is this just a global trend that India is tagging along with?
Right. Is there a global recession dragging prices down everywhere?
You know, is everyone else at 1.7% too?
Yeah.
Are we just average?
Exactly.
And the short answer is no, not even close.
Okay.
If you look at the change in inflation rates in 2025 compared to 2024, India isn't just participating in a trend. It is, and this is the key, it's leading the pack. We have a chart here comparing major economies, the UK, Brazil, the US, Germany, Mexico.
I'm looking at it now. And you're right, the UK and Brazil saw drops. Sure, they are trending down. But the slope, I mean, it isn't nearly as steep.
Not at all. India saw the highest reduction in headline inflation among all of them, a 1.8% drop in the rate.
Right.
That's a huge move.
A bigger drop than anyone else on that list.
By a long shot.
Yeah.
Meanwhile, you look at countries like Japan or China, and their inflation change is actually creeping up slightly or just hovering near zero change.
Yeah.
So this isn't just global headwinds dying down.
Yeah.
This is a specifically Indian story.
And that is our mission for this deep dive. We're not just going to sit here and clap for a low number. That's boring.
Right.
We need to unpack how this happened. Is it just luck? Did we just get great weather and that's it? Or is it brilliant policy? And crucially, we need to connect this low inflation number to the massive, almost invisible revolution happening in the agricultural sector. Because, spoiler alert for you listening, the reason your inflation is low is largely because food prices are doing something very, very unusual.
You cannot understand Indian inflation without understanding Indian agriculture.
Yeah.
They're practically two sides of the same coin.
They really are.
If you try to analyze the economy without looking at the farm, you're missing half the picture, maybe more.
So let's get into section 1. Let's dissect these numbers. Because when you actually peel back that 1.7% headline, things get a little weird.
They get very weird.
It's not a uniform drop across the board, is it? It's not like everything got 1.7% cheaper.
Not at all. It's what we call a split narrative.
Yeah.
If you look at the components of inflation, they are behaving like three different characters in a movie, and they're not getting along. They're pulling in completely different directions.
Okay, I like that analogy. Let's introduce the cast of characters. Character number 1 is headline inflation.
The star of the show.
The star of the show, that's the aggregate, the big number we just celebrated, sitting at a very low 1.3% in the specific monthly breakdown we're looking at towards the end of the year.
Right. That's the summary. That's the number that makes the newspaper headlines.
And then we have character number 2, food inflation. And this is the shocker. This is the plot twist in the movie.
This is where all the drama is.
Right.
Food inflation is at minus 2.71%.
Negative.
Negative.
Let's just pause on that. Not slow growth, not zero growth, negative.
It's deflation. That means the basket of food items isn't just getting expensive slower.
Right.
It is actually cheaper in absolute terms than it was last year.
Which is a profound shift for a consumer economy. I mean, usually we celebrate when food inflation is just low, like 2% or 3%. Negative is a whole other ballgame.
It puts money directly back into people's pockets, no question.
But then there's character number 3, the villain, maybe, and this is the one that confuses me, core inflation.
Ah, a stubborn one. The sticky one.
It's sticking at 4.62%. So let me get this straight. Food is cheaper, the headline number is rock bottom, but core is sitting up there at nearly 5%.
Yep.
For the listener who might hear core inflation on the news but kind of gloss over it, what exactly is core and why is it misbehaving so badly?
So core inflation is a metric economists love because it usually strips out the volatile stuff, so food and fuel.
The things that swing around a lot.
Exactly. The idea is to get a sense of the underlying, the more persistent price pressures in the economy. If core is high, it usually means people are buying a lot of clothes, services, paying for housing, education, things like that.
So it's proxy for demand. It typically signals a heating economy where people have money to spend.
That's the textbook definition.
So looking at 4.62%, you'd assume Indians are on a spending spree for goods and services.
You would assume that. But in this specific case, if you lift the hood, there is a culprit skewing the numbers, a specific distortion that makes the number look hotter than it might actually be.
Okay, I'm intrigued. Is it housing rent? That's usually a big one. Or is it medical costs?
Good guesses. But no, it's precious metals.
Precious metals.
Gold and silver.
Really? Gold is keeping core inflation up. How does that work?
Yes. The source analysis explicitly points out that the steady pace of core inflation has been largely influenced by higher inflation in the prices of precious metals. You have to remember, in India, gold isn't just jewelry.
Right, it's an investment.
It's not just a luxury item you buy once a decade. It's a financial instrument. It's savings. It's deeply, deeply embedded in the consumer basket and the culture.
That is fascinating. So because global gold prices are up or domestic demand is high for investment purposes, it's artificially propping up India's core inflation number.
It's propping it up, exactly. If you were to exclude gold and silver from that calculation, if you took those shiny metals out of the basket, the core inflation picture would look significantly softer.
So the underlying price pressure isn't as bad as it looks.
It implies that the cost of living for the average person, unless you're buying a gold necklace every month, is actually much lower than that 4.62% suggests.
That is such a crucial distinction. It's like saying your grocery bill is down, but the price of your investment portfolio assets is up.
That's a great way to put it.
Which is actually a pretty good situation to be in if you happen to own the assets.
It is. And if we look at the visual trajectory, we have this graph spanning from April 2024 to December 2025. You can see this divergence beautifully.
The charts really tell the story.
They tell it better than any spreadsheet table.
I'm looking at the chart now. There's a red line for core and a yellow line for food. For a long time, through most of 2024, they kind of dance around each other, they interact, they cross over.
They're correlated, more or less.
But look at what happens around September or October of 2025.
The great divergence.
It's a cliff. The yellow line food just nosedives. It plummets. It crosses the zero line and goes deep into negative territory. Meanwhile, the red line core just stays flat. It's just cruising along, hovering around that 4.5% to 5% mark. It doesn't even blink.
That divergence is the story of the economy right now. The pressure valve has been released on the most essential commodity food, while the rest of the economy, or at least the core part of it, is holding steady.
It creates a very unique macroeconomic environment.
It really does.
So let's go deeper into that yellow line. Section 2 is all about the why. Why did food prices fall off a cliff? Because usually the Indian inflation story is onions are 100 rupees a kilo, everyone panic.
Right. We're wired to expect food shocks.
And usually on the upside.
We are very used to vegetables being the villain of the story. But in 2025, they were the hero. They saved the headline number.
The data attributes this negative 2.71% figure specifically to a persistent contraction in the prices of major commodities. And the two big ones mentioned are vegetables and pulses.
If you look at the specific vegetables line on that component chart, it's just, it's erratic. It's the wildest line on the graph.
It's swinging like a pendulum. In mid-2024, it was way up, high inflation, but look at the end of 2025. It dips below minus 30%.
Minus 30%. That is massive deflation.
That's not a small change.
A 30% drop in vegetable prices is something every household budget feels immediately. That's the difference between buying just onions and potatoes and, buying the whole salad.
Absolutely. And you mentioned pulses, which are a major source of protein for so many people. They're also trending downward.
They are. The whole food basket is getting cheaper, but it's being led by these key items.
So what caused it? Did we just get lucky? Was it magic?
Well, it's a mix. It's never just one thing, right? I'd say there are three big factors here. One is mathematical, one is environmental, and one is policy.
Okay, let's do the math one first. The base effect. I hear this term all the time on financial news. Oh, it's just the base effect.
Yeah.
And I feel like half the audience nods while secretly wondering what on earth that actually means. Can we unpack this simply?
Sure. Imagine you are tracking the height of a child. Let's say last year,
They had a massive growth spurt. They grow 6 inches.
Okay, huge growth.
That's a huge number. That's your base. Now, this year, they grow 2 inches. That's a normal, healthy amount of growth for their age. But if you compare this year's growth to last year's massive growth.
It looks like a massive slowdown. It looks like growth collapsed, even though they are still growing.
Exactly. But the child is still getting taller. In inflation terms, prices were very high in late 2024. That's the high base. So when we measure prices in late 2025, even if they're just normal or slightly lower, the comparison to that high point makes it look like a huge drop.
So it exaggerates the fall.
It exaggerates the fall. The source specifically mentions that a strong base effect played a critical role in tempering headline inflation, specifically in the second half of 2025.
Okay, so part of it is just the math of comparing against a pricey previous year. But math doesn't grow potatoes. Math doesn't put tomatoes in the market. What about the environment? The weather?
This is where we got what economists and, I guess, meteorologists call a Goldilocks scenario.
Not too hot, not too cold, just right.
Literally. The report cites below normal temperatures, coupled with an above normal monsoon.
Wow, that sounds like a perfect recipe for farming in India.
It is the absolute dream scenario. The cooler temperatures prevent heat stress. You know how sometimes we get those early heat waves in March that shrivel the wheat kernels just before harvest?
Yeah, the shriveled grain headlines. We've seen those a lot in recent years, and it's always a cause for concern.
We didn't get that. We got cool temps. That allows the grain to fill out properly. And the above-average rainfall ensured plenty of groundwater recharge and reservoir storage for the subsequent seasons.
So just perfect conditions.
It created very, very favorable agricultural conditions. Supply went up. And it's Econ 101. When supply goes up, prices come down.
Basic supply and demand. But you also mentioned policy, because you can have good weather, but if the supply chain is broken, or if middlemen take all the profit, the consumer doesn't see the benefit.
Correct. And this is where the government seems to have stepped in effectively. The sources highlight policy and supply chain wins. Two things stand out. First, GST rationalization.
Rationalization, that's bureaucrat speak for fixing the tax rates, right?
Essentially, yes. They adjusted the goods and services tax on certain commodities. But here is the important part. The data says there was a pass-through of these rationalized rates.
Pass through, that means the companies didn't just absorb the tax cut and keep the difference as profit.
Exactly. That's the key. Often when taxes are cut, companies just bolster their margins and say, thank you very much.
And the consumer never sees it.
But here, the lower tax actually resulted in lower sticker prices for you and me. The market mechanism actually worked as intended.
That is rare. It's nice when that happens.
It is. And the second policy win was on stock positions. The government had improved stock positions of food grains. Think of this as a giant national pantry, a buffer.
Okay.
If you have full warehouses, the market knows there is no shortage. That psychological comfort prevents hoarding and speculation, which can often drive prices up even when there's enough supply.
Right. It stops the panic buying among wholesalers.
It calms the market down.
Speaking of speculation and hoarding, that brings us perfectly to Section 3. Because there is one specific commodity that has driven Indian families and politicians crazy for decades.
I know where you're going with this.
Pulses, Del.
The pulse cycle. It's historically been a roller coaster. It's famously, notoriously volatile.
We have a chart here titled 30-Day Rolling Standard Deviation of Daily Retail Prices, which is a mouthful.
It is a mouthful, but visually, it's very intuitive.
Don't let the title scare you.
Break it down for us. Imagine a graph that looks like a sound wave or a seismograph during an earthquake. The higher the peaks and troughs, the more shaking there is.
Okay, so bigger waves mean more price volatility.
Exactly. On the left side of the chart, back in 2015 and 2016, the waves are huge, giant spikes up and down. That represents extreme volatility. Prices would skyrocket, then crash.
I remember that vividly. 1 month Delta is 80 rupees, the next it's 200. It became a major political issue.
It was chaotic for farmers because they didn't know what to plant, and it was chaotic for consumers because their grocery bills would double overnight. It created massive uncertainty.
But look at the right side of the graph. Look at 2024 and 2025.
What do you see?
The waves are almost flat. The line is calm. It's like the earthquake stopped.
The volatility has significantly, dramatically declined, and the source attributes this directly to timely intervention.
So this isn't just the weather. This isn't just luck. This is the government getting better at managing the market.
Yes. This suggests a structural fix, not a one-off lucky year. By managing imports,
maintaining strategic buffer stocks and strategically releasing pulses into the market when prices start to creep up. They have tamed the cycle.
They've smoothed out the earthquake.
That's the perfect way to describe it.
That is a big deal. It means we aren't just at the mercy of the rain anymore, at least for this one crucial commodity. We have built a shock absorber into the system.
Exactly. And that stability allows us to look at the broader economy differently. When food isn't volatile, it changes the relationship between different sectors, which brings us to a slightly more complex, but very telling concept,
I was waiting for this one.
the terms of trade.
Ah, yes.
That's it.
Section 4, Terms of Trade. This sounds like international shipping or something out of a dense textbook, but we are talking about sectors within India, right? Manufacturing versus agriculture.
Right. And this concept can be tricky, so let's simplify it. Think of terms of trade, or TOT, as the exchange rate between two sectors. Imagine the economy is just two people, a farmer and a factory owner.
Okay, I'm imagining them. One's in a field, one's in a factory.
If you are the farmer, the question is, how many sacks of wheat do you have to sell to buy a tractor, or a shirt, or a bar of soap from the factory?
Okay, so it's about relative value, my stuff versus your stuff.
Precisely. If last year 100 sacks of wheat bought you a tractor, but this year you need to sell 120 sacks to buy the exact same tractor, your terms of trade have worsened.
I have to work harder, produce more, just to get the same thing back.
You're working harder for the same buying power. Your leverage has decreased.
Got it. So it's about purchasing power relative to the other guy.
Yes. And the data here shows a very, very interesting shift. The TOT for the manufacturing sector has progressively declined.
Wait, for manufacturing, they're the ones losing ground.
They are losing ground against both agriculture and services. We have a chart that shows the ratio of manufacturing deflator to agricultural deflator from fiscal year 05 all the way to fiscal year 25.
A 20-year trend, and what does the line look like?
It's a clear downward trend. It's sloping down pretty consistently.
So wait, let's unpack the implication here because this feels important. Does that mean, relatively speaking, the stuff farmers are selling is holding its value better than the stuff factories are selling?
That is exactly what it means. The pricing power of agriculture is holding up better than that of manufacturing, at least in relative terms.
And the report says this results in a compression in manufacturing's sectoral share in gross value added, or GVA.
Right. Its slice of the economic pie is getting squeezed, partly because its pricing power is eroding compared to the other sectors.
That challenges the usual narrative, doesn't it?
Completely.
We usually think of the poor farmer being squeezed by the big industrialist. We have this image of the factory owner dictating terms. But this data suggests that price-wise, the agricultural sector has been gaining some leverage.
It does. It doesn't mean every farmer is rich. Not at all. But it means that as a sector, its economic weight, its terms of exchange with the industrial world have improved.
It forces us to rethink how we view the rural economy. It's not just a charity case. It's a sector with increasing economic weight relative to manufacturing.
The farmer's getting a slightly better deal in the exchange. But, and this is a big but, the nature of that agricultural sector is changing dramatically. The farmer isn't just growing wheat anymore.
And that is the perfect pivot to Section 5, because if you still think Indian agriculture is just about endless fields of wheat and rice, you are living in the past.
You're living in the 1970s.
That's the Green Revolution model.
We are way past that. The news source, Chapter 6, is titled Agriculture and Food Management, but the subtitle gives it away. Diversifying agriculture. It's all about what else is happening on the farm.
Let's look at the growth champions. We have average GVA growth data from fiscal year 20 to 24. This tells us where the real momentum is.
Okay, let's play a little game here. What do you think grew the fastest? Crops.
Well, given everything we've just said about the good monsoon and bumper harvests and stable prices, my gut says crops had a pretty good run.
They did. Crops grew at 4.0%,
Yeah.
which is decent. Solid growth. Any mature sector in any economy would take 4% growth.
Sure.
But it's actually the slowest of the group we are looking at.
Really? So it's the laggard, what beat it?
Livestock,
Okay.
cows, buffaloes, goats, poultry. That whole sector grew at 6.1%.
Wow. So milk and meat and eggs are growing faster than grain.
Significantly faster, by over 50%. This shows you that as incomes rise, the demand for protein milk, eggs, meat, is outpacing the demand for basic cereals. People are changing their diets.
And the rural economy is adapting to that.
It is. But the real winner, the gold medal, it goes to fishing and aquaculture.
No way. Fishing.
Fishing
It grew at an average of 7.2% per year.
That is massive. 7.2% is like, that's tech startup growth rates. That's emerging market growth.
It is huge, and it tells us that the blue revolution, the push for fisheries and aquaculture, is real. It's not just a slogan on a government website. It's happening.
So the growth engine of the rural economy is shifting from the field to the pond and the barn.
That's such a vivid image, and it's exactly right. It's not just the tractor anymore. It's the fishing net and the dairy cooling tank.
This is crucial for you, the listener, to understand. When we talk about rural distress or rural boom, we can't just look at the wheat harvest anymore.
You can't. A farmer might have a bad crop year. Maybe the rain was a little off for their particular crop. But if he has 3 cows and a small fish pond, he has a safety net. His income is diversified.
He has cash flow from selling milk every day, even if the wheat fails once a year.
It's portfolio management for the farm. Just like an investor shouldn't put all their money in one stock, a farmer shouldn't put all their effort into one crop.
And the overall agricultural sector growth, what's that number?
The overall sector is growing at 4.7%, which is higher than the crop growth of 4.0% alone.
So that extra 0.7% boost
Is coming entirely from these allied sectors. They're lifting the average for the whole farm economy.
So if the farm is changing so dramatically, the policy has to change too, right? You can't just keep giving subsidies for fertilizer if the farmer is now raising shrimp. The tool set has to evolve.
Precisely. And that leads us to Section 6, the policy roadmap. The source text lays out some very specific and honestly somewhat complicated trade-offs that the government is wrestling with.
It's not just about spending more money.
No, it's about spending it smarter and navigating these new challenges.
Let's look at the first one, ethanol. This seems to be everywhere in the news lately.
This is the big one. This is the classic food versus fuel dilemma playing out in real time.
Right. So the goal is we want to mix ethanol into our petrol to reduce our reliance on imported oil. That's the energy security goal. You want to be independent. We want to stop bleeding foreign exchange on crude oil.
A very noble and important goal. But where does ethanol come from? It comes from sugarcane and grains. It comes from food.
So we're turning food into fuel.
We are. And the source explicitly warns about the need for careful calibration.
Calibration of what?
Of incentives. Of the price. If you make it too profitable to grow sugarcane for ethanol, if the government sets the ethanol price too high, what do you think every farmer will do?
They'll switch to sugarcane. Why grow wheat for a lower profit when you can grow sugarcane for a guaranteed high price?
Exactly. And then what happens? We run out of wheat and rice. Or the price of sugar for consumers skyrockets.
You create a shortage in the food market to solve a problem in the energy market.
You're just moving the problem.
Right.
The document warns against unintended concentration across crops. The rule, it says, is ethanol expansion must be pursued, but it has to support both energy security, A&D food, and nutritional security. You cannot sacrifice one for the other.
That is a very difficult tightrope to walk, especially if the weather turns bad. If you have a drought, do you feed the car or the person?
It's a massive ethical and economic question. And there's no easy answer, just constant, careful management.
Okay, what's the second big policy shift?
It's about dirt, literally. Fertilizer and soil health.
I feel like we've been talking about soil health for years. Save the soil campaigns and all that. What's new here? What's the new thinking?
The language is shifting. The document talks about moving from input distortion to acre-based support.
Input distortion? That sounds like a fancy way of saying we made fertilizer too cheap, so farmers used way too much of it.
That is exactly what it means. When you subsidize the input like urea heavily, farmers tend to overuse it because it's cheap. It makes sense financially in the short term, throw more urea, get a greener-looking crop.
But it destroys the soil in the long term.
It burns the soil out, it alters the pH, it kills the beneficial microbes, it hardens the ground. You get diminishing returns year after year.
So what's the new goal?
The new goal is to align fertilizer use with agronomic needs.
Yeah.
Using what the soil actually needs based on a soil test, not just what's subsidized.
And the acre-based support, what does that mean?
That suggests a shift in how the subsidy is delivered. Instead of making the bag of urea cheap, maybe you give the farmer a certain amount of money based on the acres of land they hold.
A direct cash transfer.
A direct transfer, which allows them to choose the right inputs for themselves. Maybe their soil needs organic compost, not more urea. Maybe it needs potash. If you give them the cash, they can make that choice.
That makes a lot of sense. It treats the farmer like a manager who knows their own land rather than pushing a specific chemical on them.
It empowers them. And that links directly to the third policy filler, crop diversification.
Which we've already touched on. We all agree farmers should grow different things. We don't want everyone growing water-guzzling rice in dry areas like Punjab or Haryana. But switching is risky.
It's terrifyingly risky for a small farmer with no savings.
Right. If I've grown rice my whole life, and my father before me, switching to lentils or oilseeds feels dangerous. What if the crop fails? What if I don't know how to grow it? What if nobody buys it at a good price?
All valid fears. And that's why the policy proposes per acre, per quintal incentives, specifically to cover transition losses.
So they are essentially underwriting the risk. The government is saying, we will cover your loss while you learn to switch.
Yes, it's bridge funding. The logic is that crop choices must reflect local realities, the soil type, the rainfall, the market conditions, not just growing rice because the government guarantees it'll buy it.
And the long-term economic argument is strong.
Very strong. If you grow the right crop for your soil, your input costs, water, fertilizer, go down, and your profits should improve. But you need that bridge funding to get from here to there.
It sounds so logical, but making it happen across millions and millions of small farms is the real challenge.
It is. It's an implementation nightmare.
Yeah.
And that requires a massive support ecosystem to pull it off. Which brings us to our final section, Section 7.
The government support ecosystem. Now, whenever I see these government documents, it's just a laundry list of acronyms. PM this, Yojana that. It makes my eyes glaze over. It feels like alphabet soup.
It can be overwhelming, but if we organize them, you can see the strategy behind the soup. Think of it as building a house. You need pillars. You can't just have a pile of bricks lying around.
Okay, I like that. Let's build the pillars. Let's make sense of the alphabet soup for everyone listening. Pillar 1.
Pillar 1 is income support. This is the foundation, the safety net. This is about making sure the farmer's basic income is protected.
Okay, so this includes PM Kisan.
Yes, PM Kisan, the Pradhan Mantri Kisan Samman Nidhi. This is simple. Direct cash transfers into bank accounts. No middlemen. Just cash to help with liquidity before the sowing season.
What else is in this pillar?
This pillar also includes the MSP, the minimum support prices, which guarantees a price floor so farmers don't get wiped out if the market tanks. And it also includes the PM Mantan Yojana, which is a pension scheme for aging farmers.
So pillar 1 is basically, here is cash and a price guarantee to ensure you don't fall into poverty. It's the floor.
Correct. Now, pillar 2 is input support. This is the tools to farm.
The physical stuff you need to actually grow things.
Exactly. Seeds, specifically high-yielding varieties. Water that comes under the Pradhan Mantri Krishi Sinchai Yojana for irrigation projects.
And soil health.
Soil health cards to tell you what your dirt needs. And the fertilizer subsidies we discussed, in whatever form they take.
And money to buy it all, the Kisan credit card, the KCC.
Exactly. That gives them access to formal credit so they don't have to go to a local money lender charging, 50% interest. It's crucial.
And you mentioned this earlier, but this pillar is also diversifying.
It is. There are specific schemes mentioned for foot and mouth disease control for livestock and the PM Matsya Kisan Samriddhi Sayokana for fisheries.
That is a mouthful, but it shows they're putting money where the growth is, fish and cows. They're supporting the diversification we talked about.
Right. And finally, Pillar 3, policy and institutional support. This is the structure or the rule book for the whole system.
So this is the big picture stuff. What falls under this?
These are the big missions. The National Food Security and Nutrition Mission. The missions on edible oils, specifically oil seeds and oil palm.
Oh, that's so important. We import a huge amount of cooking oil, don't we?
We do. It's one of our biggest import bills after crude oil and gold. So reducing that import dependence is a huge strategic goal for the country.
And what else?
This pillar also includes the promotion of FPOs, or farmer-producer organizations.
That's about making small farmers team up to act like big companies, right?
Yeah, it's a great way to put it. It's about collective bargaining power. If 100 small farmers come together to buy seeds, they get a bulk discount. If they sell their produce together, they can negotiate a much better price than one farmer selling alone.
It gives them scale.
It gives them scale. And finally, the Digital Agriculture Mission. Integrating tech into all of this, using drones for spraying, apps for weather forecasts, online platforms for selling produce.
So when you look at it that way, income, inputs, and institutions, it's actually a very comprehensive safety net. It's not just throwing money at a problem. It's trying to build a modern, resilient sector.
It is. It's an attempt to move from subsistence farming, just surviving year to year, to agribusiness, where farmers are treated as entrepreneurs.
So we've covered a lot of ground today. From the macro inflation numbers, that surprising 1.7%, all the way down to the micro details of fish farming and soil health cards. Let's try to bring it all back together now. What is the synthesis here? How should the listener file this away in their brain?
The synthesis is that India is in a unique and um, quite favorable economic moment. We have record low inflation, which is largely being driven by a crash in food prices.
A crash that feels good for consumers.
It feels very good for consumers.
Yeah.
But this crash isn't necessarily a sign of agricultural distress. It's partly due to great weather, those Goldilocks conditions,
Yeah.
and partly due to structural improvements in how we manage volatility, like we saw with the pulse prices.
And at the same time, the farm itself is evolving. It's not shrinking, it's diversifying. It's moving into these high-value sectors like fisheries, which is growing at 7.2%, and livestock. It's becoming more sophisticated.
And the terms of trade shift we discussed tells us that agriculture, as a sector, is holding its own against manufacturing in terms of pricing power. The economy is managing to stabilize its most volatile component, food, which is a huge achievement.
So what for the listener is this? You are looking at an economy that is trying to modernize its massive rural base while at the same time enjoying a period of price stability that gives policymakers room to breathe.
Exactly. Low inflation gives you the political and economic space to make hard structural changes like the ethanol shift or the fertilizer reform without people rioting over the price of onions. It buys you a window of opportunity to do the difficult things.
That is a great point. Stability buys you time for reform.
But there is always a question mark. There's always a risk.
There is always a question mark. And I want to leave the listener with this one, going back to something we discussed earlier.
Yes.
We talked about the ethanol versus food security trade-off.
Yes, the big dilemma.
We are pushing hard for energy independence. We want to fuel our cars with our own crops. But we also have 1.4 billion people to feed.
And we currently have Goldilocks weather, the perfect conditions.
Exactly. So here is the provocative thought to end on. As we push for energy independence through ethanol, are we ready to manage the delicate trade-off between fueling our cars and feeding our population, especially if these Goldilocks weather conditions don't last? What happens when the bad monsoon comes? When the drought hits? Do we choose the petrol pump or the plate?
That is the billion-dollar question, and one we will have to watch very, very closely in the years ahead.
Something to mull over. Thank you for joining us on this deep dive. We hope you feel a little smarter, a little more informed, and maybe ready to impress your friends with your knowledge of terms of trade.
See you next time.
Bye for now. Welcome back to the deep dive. We are doing something a little different today. Usually we take, a specific topic like a new tech trend or a historical event and we just drill down. But today we're zooming out before we zoom in. We're looking at the machine itself, the engine room.
It is a very significant moment to be looking at the dashboard, that's for sure.
It really is. I mean, at this stage, it becomes so important to assess how all these different factors influence the economy as a whole.
Right.
And I don't say that to sound, academic. I say that because when I opened up this stack of research regarding the economic landscape of 2026, I genuinely had to double check some of the numbers.
You're not the only one. I had the same reaction.
Wow.
The data we're looking at today, it paints a picture that is, well, it's somewhat counterintuitive if you've just been following the global headlines for the last few years.
Exactly. Our mission today is to assess the specific factors that are currently influencing the economy, specifically focusing on this weird, fascinating interplay between the services sector, which everyone thinks they understand.
Thinks being the operative word.
Right. And the industrial manufacturing sector.
The twin engines.
Right, the twin engines. But before we get into the nuts and bolts, I need to address the elephant in the room. Or maybe the rocket ship on the chart. I'm calling it the global outlier moment.
You must be referring to the gross value added data, the GVA.
I am. And for you listening who might glaze over at an acronym like GVA, let's just call it the actual economic value being generated in a sector.
Sure.
I'm looking at a chart here that compares the services sector performance of major global economies, and it's all benchmarked against their pre-COVID levels.
This is the baseline comparison, the big question.
Yeah.
How is everyone doing compared to before the pandemic just changed everything?
Exactly. So you look at the UK, you look at the EU, even China, and they're all showing these, varied rates of recovery. Some are up a few percentage points, some are flatlining, some are really struggling to find momentum. It looks like a standard recovery chart.
A mixed bag.
A mixed bag. But then you look at India's line on this graph.
It stands out, doesn't it?
Stands out. It looks like it's trying to escape the chart. It's not just recovering, it's deviating. It is significantly outperforming the global trends. It's like the line just decided to take off on its own trajectory, completely ignoring what the rest of the global peer group is doing.
And that visual divergence is Well, it's crucial for you to really internalize. Because what it tells us is that we aren't just seeing a bounce back anymore. We need to be careful with our language here. A bounce back is cyclical. You fall down, you scrape your knee, you get back up to where you were.
That's recovery.
Exactly. Recovery is just returning to zero. What we seem to be seeing here is a structural transformation. The economy has moved past the recovery phase and entered an expansion phase that looks fundamentally different from its peer group.
So the underlying machinery has been upgraded, not just repaired.
That's the perfect analogy.
Yeah.
It suggests the engine has a higher horsepower now.
So the big question we're answering today, and we are going to take our time with this because the details really matter, is how? How did the economy move from just getting back to normal to this structural transformation?
Yeah.
Because let's be honest, we've heard hype before. We've heard India shining or the next superpower for decades. Why is this data set different?
To answer that, I think we have to navigate two massive interconnected landscapes. We have to look at what you could call the services superhighway, and that
Yeah.
involves employment, high-value tech, the urban lifeblood.
Okay.
And then we have to pivot to the industrial renaissance.
Which covers the manufacturing optimism, the EV revolution, and that electronics boom we keep hearing about.
And I should warn you and the listener,
Yeah.
the scale of the numbers we're about to discuss is,
Oh, except
well, it's aggressive.
aggressive is a polite way to put it. Some of these charts are nearly vertical, and that, it makes me skeptical. I'm going to be the designated cynic today because when I see vertical lines on an economic chart, my first instinct is bubble or typo.
And that is a very healthy instinct to have. My job today is to look past that vertical climb and ask, is it sustainable? Is it structural? Or is it just a flash in the pan?
All right, let's get into it. Section 1, the services sector. Now, I want to play a quick word association game.
Okay.
If I say Indian services sector to the average person on the street, or even, the average investor in New York, what's the first image that pops into their head?
A call center. Well, certainly a call center. Probably a large room, lots of headsets, people reading from scripts, helping you reset your password.
Have you tried turning it off and on again?
Precisely. That is the vintage 1990s, early 2000s image of the sector.
But looking at this report, that image is about as relevant today as a floppy disk. The data paints a completely different picture. Let's start with just the sheer volume of people involved here.
Human scale of it.
Yeah. The data shows that services now account for 30% of total employment in the country. Now, 30% might not sound like a monopoly, but you have to slice the data.
You have to look at where those people live. It's all about the geography.
Exactly. And here's the kicker. Services accounts for a staggering 61.9% of urban employment.
Let's just pause on that number. 61.9%.
Yeah.
This is a critical distinction. When we talk about urban lifeblood, this is exactly what we mean. Almost 2/3 of the jobs in cities are driven by this one sector.
So that defines the rhythm of the city.
Everything. It defines the commute patterns, it defines the real estate market, it defines where cafes open.
It basically means that if you're walking down a street in a major metro in 2026, 2 out of every 3 people you pass are working in services. They aren't in a factory, they aren't in agriculture, they're in this broad bucket of services.
And services is a very broad bucket. We should be clear on that. It covers everything from the delivery rider bringing your lunch, to the nurse at the hospital, to the software architect, to the investment banker. It is the pulse of the urban ecosystem.
But are these good jobs? That's the question that always comes up. Because gig work is technically services, right? And we hear so much about the precarious nature of the gig economy.
That is the most important question you can ask. Are these stable jobs? And for that, we have to look at the EPFO data.
The Employees Provident Fund Organization. For the listeners, that's the main Social Security and pension fund.
Correct. So the EPFO tracks formal jobs. These are jobs with Social Security, with a paper trail, with benefits.
The jobs that let you sleep at night, the ones with a pay stub.
Exactly. And the data here is, it's really clear. The services sector is responsible for 51.7% of all formal job creation.
51.7.
So it is literally edging out all other sectors combined, which sit at 48.3%.
Yeah, I want to drill down on why this matters so much to you, the listener. Why should you care about EPFO data? It sounds like bureaucratic alphabet soup.
It matters because of what formalization unlocks for a human being. In an informal economy, cash in hand, your economic life is very fragile. If you get sick, you might starve. You have no safety net.
And you're invisible.
You are totally invisible to the financial system. You cannot walk into a bank and get a loan because you can't prove a steady income. You can't get a credit card.
So you're locked out of building wealth.
Completely.
Yeah.
But when you have an EPFO record, You are visible. You are credit worthy. You can get that credit card. You can get a car loan. You can get a mortgage to buy a home.
So when we see that services are creating over half of the new formal jobs, we aren't just saying more people are working. We're saying more people are entering the credit-worthy, stable middle class.
Exactly. And that creates a robust floor for the urban economy. These are the people who buy furniture. They buy appliances. They go on vacations. It kicks off a powerful consumption cycle that informal work just cannot support.
It's the engine that keeps the malls full and the housing market moving.
Precisely.
And speaking of malls and consumption, I stumbled upon something in the report that I honestly did not expect to see in a dry economic survey. I usually expect to see steel, coal, wheat, but there was a whole section on what they're calling the orange economy.
Ah, yes. The creative economy.
I love this term, orange economy. It sounds like a new soda flavor, but it's actually about creativity. We're talking about cinema, gaming, animation, and the numbers. Well, let's look at them. Live entertainment alone is generating over 100 billion rupees.
Yeah.
And that is a 2024 estimate, so it's likely higher now in 2026.
It is a fascinating shift. For a long time, economists used to dismiss this sector. They called it soft stuff. You know, nice to have, but not a pillar of the economy. But 100 billion rupees, that's hard currency. That's a real pillar.
But hold on, let's break that down. 100 billion rupees on live entertainment. What are people actually spending this money on? Are we just talking about buying a movie ticket for 300 rupees? Or is this something bigger?
It's a mix, but the domestic appetite for experiences, the real story here. See, usually in a developing economy, discretionary spending goes to goods first. You get a little extra money, you buy a better fridge, you buy a motorcycle, you buy gold.
Tangible assets, things you can touch.
Exactly. But here we're seeing a massive pivot to experiential spending. That 100 billion isn't just cinema tickets. It's music festivals in Tier 2 cities. It's stand-up comedy circuits that are now national tours. It's localized gaming tournaments with real prize money.
So it implies that the middle class isn't just surviving, they're looking for identity. They're paying to feel something, to be part of something.
It sounds like Maslow's hierarchy of needs in action, doesn't it?
It really does. We've fed ourselves, we've housed ourselves, and now we want to be entertained and self-actualize.
Exactly. And look at the digital side of this orange economy. Digital media now makes up 1/3 of the total revenues in the sector.
And gaming. I have to call out the gaming number. Revenue from gaming is sitting at 232 billion rupees. Animation and VFX, another 103 billion.
The gaming number is so significant because it represents a massive demographic shift. This isn't just kids playing Candy Crush on their mom's phone anymore.
No.
This is a mature market of esports, competitive leagues, console gaming, and a burgeoning game development industry.
And the VFX number, 103 billion. That connects to something else, doesn't it? Because we aren't just consuming these movies and games, we're starting to make them for the world.
Correct. From a business perspective, the animation and VFX number is crucial because that isn't just domestic consumption, that is an export service.
We're selling our creativity.
We are. Indian studios are doing the post-production for massive global blockbusters, Marvel movies, big sci-fi epics. A lot of those incredible pixels you see on screen are being polished in studios in Mumbai or Bangalore or Hyderabad.
So this creative money is also export money.
Which is a perfect segue to the next part of the services story, moving up the value chain. Because if we're doing the VFX for Hollywood or designing the levels for a global video game, we certainly aren't just answering phones anymore.
No, we are not. And the data on export services is very revealing on this point. If you look at software services, the classic IT stuff, the bread and butter, it's growing at a healthy rate, about 4.7%.
Steady. It's a cash cow.
It is.
Yeah.
But then you look at the line for professional and management consulting.
It is surging. It's at 13.5%.
That is nearly triple the growth rate of standard software services. That's a huge divergence.
This is a very, very important signal for you to pick up on.
But what does it actually mean? Professional and management consulting. It sounds like jargon. Are we just exporting PowerPoint slides now?
In a way, yes. But they are very expensive, very high leverage PowerPoint slides.
Huh. Okay.
When we say management consulting in this context, we mean that India is becoming the strategy room for the world, not just the back office.
Elaborate on that. Give me a concrete example.
Well, 10 years ago, a global bank might have sent their data entry work or their basic coding to India. Low skill, low cost.
Right, the labor arbitrage play.
The classic play. Today, that same bank is setting up a team in India to analyze global financial risk, to ensure compliance with complex international laws, to design their entire ESG strategy for the next decade, or to model their financial future using AI.
So instead of type this into the computer, it's tell us what we should do next.
Precisely. It indicates that global companies are trusting Indian talent not just to execute a task, but to solve complex, open-ended strategic problems.
And this aligns with another acronym I keep seeing in the business press, GCCs, Global Capability Centers.
Yes. And the report notes a 1.2x increase in these centers, which is a significant number.
For those who don't know, let's clarify. A GCC isn't just a fancy name for an outsourced vendor, is it?
Correct. That is a common misconception. A GCC is an extension of the headquarters. It is owned and operated by the parent company. So if a massive U.S. retailer opens a GCC in Hyderabad, those employees work directly for the retailer.
They're not contractors.
They're not. They are part of the core team. They do R&D there, they do product innovation, they run global supply chains from there.
So when you see GCCs multiplying, it means global corporations are planting their flags and saying, we need the brainpower here to drive our global operations. It's a vote of confidence in the talent pool.
It completely changes the career trajectory for young, talented people. You no longer have to emigrate to work for the HQ of a Fortune 500 company. The HQ has, in a sense, come to you.
So if I'm a listener trying to figure out where the career heat is in 2026, it's in that specialized, high-value problem-solving space.
Without a doubt.
It's in the orange economy for the creatives, and it's in management consulting and GCCs for the strategists and the techies.
That is a very fair assessment. The era of basic cost arbitrage, do it here because it is cheaper, that's fading. That is a race to the bottom, and other countries can always be cheaper.
Right.
The new era is do it here because the talent is better, more specialized, and creates more value. That is a race to the top.
Okay, so we've established that the services sector is booming, it's creative, and it's getting smarter. It's the brain of the operation. But here's the thing about brains. They need a body. A digital economy still needs physical things. You can't email a bag of cement. Can't download a car.
You cannot, though I'm sure the orange economy is working on that in the metaverse. But in the real world, no. You need to move atoms, not just bits.
And that brings us to Section 2, infrastructure and logistics, the arteries of commerce.
I like that image. If services are the nervous system controlling everything, then logistics are the circulatory system.
Yeah.
You need to move goods and people efficiently, or the whole body just cramps up and dies.
And looking at these charts, the body is definitely not cramping. We're comparing the baseline from FY16 to FY20 against the projections for FY26. Let's start with the sky, air traffic.
This is one of the most dramatic, maybe the most dramatic shift we are seeing in the entire data set.
Dramatic is, well, let me describe this chart to you. I am looking at the chart for air cargo. It shows a projected jump from a baseline of 2.6 million tons to 2030.8 million tons.
Yeah.
Okay, pause. Wait. I'm looking at this air cargo chart. It says we're going from a baseline of 2.6 million tons to over 1,000 million tons. That's not a growth curve. That's a typo. Surely. That's a 400x increase? Is that real? Or did someone just slip on the zero key?
It does look like a vertical wall, doesn't it? And you are absolutely right to be skeptical. If that were a pure volume metric of existing goods, like, say, shipping sand, it would be impossible.
Right.
What we are likely seeing here is a combination of a couple of things. One, there could be a change in reporting units or categories in the projection. Sometimes data sources aggregate things differently for future estimates. But two, and this is the crucial economic point, it represents a massive multiplier in capacity and the value of goods being shipped.
Okay, explain that, the value part.
Think about what you ship by air. You don't send coal by air. You don't send wheat by air. It's just too expensive.
Right.
You send high-value, low-volume, time-sensitive items. Electronics, pharmaceuticals, precision components, perishable luxury goods like flowers or seafood.
Smartphones, vaccines, the latest fashion.
Exactly. So seeing even a fraction of that kind of explosion in air cargo capacity tells me that the type of goods we are manufacturing and exporting has fundamentally changed. We are moving from heavy, low-value goods to light, high-value goods. The economy itself is becoming lighter but more expensive.
So the value density of our exports is forcing this air capacity upgrade.
Precisely. We aren't filling planes with rocks. We're filling them with microchips and medicines.
And this also must mean a shift in the type of aircraft.
100%. This points to a move away from just relying on belly cargo, stuffing boxes in the hold of a passenger plane, to dedicated freighters. You can't run a global supply chain for iPhones relying on whether there's extra space on the flight to London.
Yeah.
You need dedicated, scheduled freighters.
That connects right back to the electronics boom we're going to talk about later. But it's not just boxes flying, it's people, too. The chart for air passenger handling, it shows a significant visual increase. The bars are just climbing the ladder steadily.
Which confirms the rising income levels and business activity we were just talking about. More consultants from those GCCs flying to meetings. More families from the formal sector taking vacations. The flying class is expanding beyond just the top 1%.
And what about on the ground and at sea? What's the story there?
The story is consistent, though less vertically shocking. Port cargo traffic is rising from about 494 million tons to around 751 million tons.
That's a roughly 50% increase.
It is, which is still massive when you're talking about millions of tons of goods.
That's a huge number.
It is, and it implies a massive efficiency upgrade at the ports themselves. It's not just building new ports, it's about turning the ships around faster, better container management, quicker customs clearance.
And rail.
Rail freight is moving from around 673 million tons to about 170 million tons. Again, a very strong, very significant jump.
So across the board, air, sea, land, we are seeing a massive expansion in our capacity to move things.
Yes, and the takeaway for you, the listener, is this. The physical capacity to move things is expanding rapidly to match the digital capacity to sell them.
That's a great way to put it.
Often in developing economies, you have a bottleneck. You have the demand, the services sector and e-commerce says buy this, and you have the factory that can make it. But the road from the factory to the port is broken, or the port itself is clogged.
It's the Amazon Prime effect. You click buy, but if the truck gets stuck in a pothole for 3 days, the entire economy drags. Your promise to the customer is broken.
Exactly. These numbers suggest a concerted effort to remove those bottlenecks so that growth doesn't get choked off by bad infrastructure. It's like upgrading your home internet connection because you bought a 4K TV. You need the bandwidth to handle the new demand.
Okay, so we have the brains, that's the services sector. We have the arteries, that's the logistics. Now let's talk about the muscle. Section 3, the industrial and manufacturing surge.
This is where the twin engines concept really clicks into place and starts to make sense as a single system.
And I want to start with a vibe check, a sentiment check. Because usually when you talk to manufacturers, they are the grumpiest people in the room.
They often have very good reason to be. It's a tough business.
Raw material costs are up, labor is hard to find, regulations are killing us. It's a constant stream of complaints. But we have this metric here called the Business Expectations Index, or BEI.
The BEI is a sentiment tracker. The Reserve Bank of India essentially asks manufacturers, how do you feel about the next quarter? Are things looking up or down? Any number above 100 means optimism. Below 100 means pessimism.
Simple enough. And looking at this chart, from March 2022 all the way through the projections for September 2025, that line is hovering consistently above 100.
It's not just above 100, it's solidly in the 110, 120 range.
It's not dipping, it's just staying in the happy zone.
And that consistency is very rare. Usually you see volatility in these sentiment indices. Oh, global oil prices are up, we are sad. Oh, taxes are down for a quarter, we are happy. But this sustained optimism suggests that manufacturers are seeing real, tangible, sustained demand. They aren't worried about the rug being pulled out from under them.
So I have to play devil's advocate here.
Please do.
We've heard about the manufacturing renaissance for a decade or more. Make in India has been on billboards forever. Is this data actually showing results, or is it just more optimism from a survey team? Is this real, or is it just sentiment?
That is a fair cynicism to have.
Yeah.
And if we were looking at this 5 years ago, I might have agreed with you. It was largely aspirational. But look at the composition of manufacturing value added now. There's a key stat in this report that really stands out to me.
Okay.
Medium and high technology activities now account for 46.3% of the total manufacturing value added.
Wait, say that again? Nearly half.
Nearly half. 46.3%.
That is my aha moment right there. I think a lot of people, myself included sometimes, still have this 1980s mental image of Indian industry, you know, textiles, raw materials, basic assembly, smokestacks, and manual labor.
Right.
But nearly half of the actual value is coming from medium and high tech.
Correct. We aren't just making stuff anymore. We are making complex stuff. Precision engineering, specialty chemicals, advanced machinery, pharmaceuticals. This completely changes the profit margin, and it changes the workforce requirements. You need more engineers, fewer laborers.
And the poster child for this has to be electronics, specifically mobile manufacturing. I have the chart right here, and it's just wild. In FY15, the production value was 0.18 lakh crore. Tiny, a blip. You could miss it.
Practically zero in the grand scheme of things. And now,
In FY25, the projection is 5.45 lakh crore.
that is a genuine transformation. And you need to notice the shift in the narrative here. 10 years ago, the big headline was, India imports millions of phones. We were sending billions of dollars out of the country.
We were just consumers.
We were just consumers. Today, domestic production is vastly outpacing imports. The sector has flipped to become a net positive driver for the economy. We are assembling for ourselves and increasingly for the world.
It's incredible to think about how fast that happened. It's basically a decade.
In economic terms, a decade is a blink of an eye for building an entire ecosystem from scratch. You can't just build a factory shell and hope for the best.
No.
You need the supply chains, the component makers, the skilled labor. You need the company that makes the specialized glass, the one that makes the battery, the one that handles chip packaging. It all has to come together.
Speaking of batteries, let's talk about the car in the driveway, or the scooter on the street, the green transition, the auto sector.
The EV revolution.
Revolution is the right word, although I feel like we use that word too much. But look at the numbers here. Total EV registrations are growing at a CAGR that's a compound annual growth rate of 62.5%.
Let's put that in context for you.
Mm.
A good growth rate for a mature industry is maybe 5 or 6% a year. 62.5% is explosive. It suggests we are on the steepest part of the S-curve of adoption.
The visual on the bar chart is practically a vertical line again. It goes from just a tiny sliver in FY20 to this massive block in FY25. But let's dig into the why. Is this just because of government subsidies, or do people actually want these things?
Initially, it was kickstarted by subsidies, for sure. That got the ball rolling. But a sustained 62% growth rate suggests consumer preference has fundamentally shifted. The running cost of an EV is dramatically lower. For a delivery driver, remember our gig worker from Section 1. An electric scooter means more take-home pay at the end of the day because they aren't paying for petrol. It's a no-brainer.
That makes perfect sense. It's simple household economics for the user.
But this matters for the industrial renaissance because the automotive sector is a huge employer and a huge part of the economy. As it shifts to EV, it demands totally new skills, new supply chains. You need battery management systems, charging infrastructure, a ton of software integration.
It's a different kind of car.
Completely.
Yeah.
This isn't a niche market anymore. It's a mainstream shift that is influencing the auto sector's total production and domestic sales numbers.
So if you're a mechanic or an automotive engineer or a car dealer, the cheese has moved. The cheese is now electric.
Indeed. And if you are still just learning how to fix a carburetor, you might want to learn how to fix a circuit board instead.
But, despite all this high-tech talk chips, satellites, EVs, we still need the basics.
Yeah.
We can't live in the cloud. We still need the building blocks of a physical economy.
You cannot build a high-tech factory without cement and steel. You cannot build a runway for those cargo planes without concrete.
Right. And the data covers that too. Cement and steel are both showing these steady, strong upward trends in installed capacity and production. It's not explosive growth like EVs, but it's consistent, solid growth.
Which you'd expect to see in a country that's building so much infrastructure.
And coal domestic production is rising sharply.
Which is an interesting point because at the same time, imports of coal as a share of consumption are moderating.
So we're digging more of our own coal to power these new factories in the grid. Is that a good thing? I mean, environmentally?
It is a trade-off, and it's a messy one. From an energy security perspective, it's very good to not be dependent on volatile international markets for imported coal.
Sure.
From an emissions perspective, it highlights that the energy transition is not a clean, simple switch. It's messy. We are building EVs, which are green, using steel that is made with coal, which is black.
Right.
But you cannot have the green future without building the infrastructure for it first, and that takes a lot of energy.
And the implication here seems to be that you can't have a services boom or a tech boom without the physical concrete and steel to build the offices and factories.
Exactly. It confirms what we saw hinted at in the services section about the real estate sustained upcycle. You need steel for the high-rises where the consultants work. You need cement for the ports where the electronics are shipped from. It is all connected.
The old economy commodities are literally fueling the new economy growth.
The twin engines are actually feeding each other. Industry builds the office. Services fills the office. Services makes money to buy the EVs. Industry builds the EVs.
It's a virtuous cycle.
When it works, yes.
Okay, let's move to Section 4. Because if we want to keep this cycle going for the next 20 years, We need new ideas. We can't just keep assembling things other people invented. We need to focus on innovation.
This is where we look at our global standing. Are we just copying or are we actually creating?
The Global Innovation Index says we are climbing the ladder pretty consistently. But let's look at the specific rankings because some of these really surprised me. We are ranked 4th globally in trademarks.
Which reflects that entrepreneurial energy we talked about. People are branding their ideas, they're building businesses, and they want to protect their identity.
Then we're 6th globally in patents.
Okay.
And 7th in industrial designs.
The patents data is particularly telling. If you dig into that, you see that patent applications have nearly doubled from FY20 to FY25.
Doubled. In 5 years. That's a lot of paperwork for the patent office.
It is, but think about what a patent really represents. It's an economic moat. It is a claim on a piece of the future.
It's a legal document that says, I own this idea.
Exactly. When you see patent applications double, it tells you a few things. It tells you that R&D spending is working. It tells you that companies feel safe filing patents because they believe the legal system will protect their intellectual property.
And most importantly,
It represents a clear shift from imitating, where you just make a generic version of a drug or machine someone else invented, to innovating, where you invent the molecule or the algorithm yourself.
so this is planting the seeds for future economic growth. You file the patent today, you own that market in 5 or 10 years.
Precisely. That's the long-term game.
And it's not just random gadgets we're patenting. We have data here from ASPI, the Australian Strategic Policy Institute. Now, these guys track critical technologies.
This is a very prestigious and very serious global benchmark. They track who is leading in the technologies that will define the 21st century.
And the data says India is now in the top 5 globally for 45 out of 64 critical technologies.
That is a staggering statistic. Let that sink in.
And look at the comparison. In the period of 2003 to 2007, that number was just 4. We were a leader in only 4 of these critical technologies.
And now it's 45.
We went from 4 to 45. That is a massive expansion of national capability.
It really is.
But what kind of technologies are we talking about here? Critical technology sounds like something from a spy movie.
It is a future tech landscape. We are talking about artificial intelligence and machine learning, quantum computing, advanced materials and manufacturing, hypersonics, biofuels, synthetic biology.
So this isn't about being good at making 1990s technology better. This is about being at the cutting edge and being ready for the shocks and opportunities of the 2030s and 2040s.
Precisely. If you are a leader in these critical technologies, you are less vulnerable to supply chain blackmails or geopolitical shocks. You own the IP. You own the know-how. If the world suddenly needs a specific type of biofuel or a specific quantum encryption algorithm, you aren't begging for it, you are selling it.
It positions the economy to be a maker of the future, not just a user of technologies developed elsewhere. And speaking of the future, let's go to the final frontier. Section 5, New Frontier Space and the Ocean.
Space is the ultimate high ground, both literally and economically.
I have to admit, I used to think of national space programs as just money pits, hugely expensive science experiments that cost billions. National pride projects, great for a parade, bad for the national budget.
The common perception.
But the data here completely flipped that script for me.
It is a business now, a very serious, very lucrative business.
The stats are incredible. 393 foreign satellites launched between 2015 and 2024.
Just think about that. Foreign countries, and more importantly, foreign private companies, are paying India to put their valuable hardware into orbit. Why? Because the Indian launch program is reliable and extremely cost-effective.
We're the FedEx of low Earth orbit.
You could say that.
And the revenue backs that up. Export earnings of around $433 million. And look at the NSIL revenues. That's New Space India Limited, the commercial arm of the space program. It shows a massive jump from 322 crore rupees in FY20 to a projected 3,246 crore rupees in FY25.
That is a 10x growth in just 5 years.
That's a startup growth curve.
It absolutely is. Space exploration is no longer just a cost center for science. It's a profitable business. Commercial launches, satellite data services, ground station services.
And it creates a huge downstream economy, I imagine. If you have your own satellites, you have better data for everything else happening on the ground.
Exactly. Modern agriculture relies on satellite imaging for crop health monitoring. Urban planning relies on it for mapping. Disaster management relies on it for early warnings. If you own the satellites, you get that data cheaper, faster, and more securely. It pays dividends right back here on Earth.
And speaking of Earth, let's look at the other final frontier, the one covering 70% of the planet, the blue economy.
The oceans.
Yeah.
A vast, untapped resource.
The report talks about developing ocean tech via PPP public-private partnerships, and something that sounds a bit like a vacation plan, a marina development policy.
It sounds recreational, but it connects directly back to high-value tourism and employment.
Explain that connection.
Well, look at the Mediterranean or the Caribbean. The blue economy isn't just about fishing or offshore oil. A huge part of it is yachting, cruising, coastal tourism. If you develop world-class marinas, you attract high-spending tourists, you create jobs for boat mechanics, hospitality staff, tour guides, supply logistics for the boats.
So it's about maximizing the economic value of the thousands of kilometers of coastline we have.
Just like we're maximizing the value of our airspace with satellites, it is about finding economic value in every square inch of the territory, land, sea, and air.
So we've covered a lot of ground, from the consulting rooms in the city where people are designing global corporate strategy, to the factories building EVs, all the way to the launch pads sending satellites into orbit. Let's move to our final section, Section 6, synthesis. How do we make sense of the economic whole?
We need to see how these pieces fit together, because if we just look at them as a list, it's just a list of nice things happening. But a real resilient economy is a machine where the parts work together.
Right. Let's try to trace the life of a product or an idea in this new economy. Let's connect the dots for the listener.
Okay, let's try this. Start with Section 3, the industrial surge. High-tech manufacturing creates the hardware. Let's say a new sophisticated sensor for a smart car.
Okay. We have the sensor. It's made in a factory in Pune.
Then Section 1 kicks in. The services sector, maybe a team in a GCC in Bangalore, writes the specialized software and the AI algorithms that go on that sensor to make it intelligent.
So now we have a smart sensor, not just a piece of metal.
Exactly. Then Section 2, logistics. It moves that smart sensor efficiently to the port via a new dedicated freight corridor, and then it flies out on one of those new cargo planes we talked about.
To a car factory in Germany or Japan or the US.
Right. Meanwhile, Section 4, the innovation ecosystem, has already filed a global patent for that sensor's unique design, securing the profit so that the idea isn't stolen by a competitor a year later.
Smart, protecting the value.
And finally, Section 5 comes in. The new frontiers, maybe a navigation satellite launched by ISRO, provides the high-precision GPS data that the sensor in the car uses to navigate.
It's a complete ecosystem, a closed loop. Every section we discussed supports the others.
And that diversity, that interconnectedness, creates resilience. This is probably the most important point for long-term stability.
How so?
If one sector takes a hit, say a global slowdown in manufacturing demand, the services sector might still be booming because companies worldwide still need consulting and software. Or if the tech sector slows down, the massive infrastructure build-out keeps people in construction employed. The economy is less vulnerable to single-sector shocks because it has multiple engines running at once.
It's like a stool with 5 strong legs instead of one wobbly one. It's much harder to knock over.
Exactly.
That's the goal. And what's the glue holding all this together? I notice a brief mention of startups in the report.
Yes, the fact that India is the world's third largest technology startup ecosystem is critical. They act as the glue. They're the nimble players who are often building the bridge between the satellite data and the farmer, or between the complex logistics provider and the small manufacturer. They provide the agility and fill the gaps.
They are the ones finding the cracks between these big sectors and filling them with value.
Precisely.
So bringing it all home for our outro, we've looked at the twin engines, we've looked at the rockets, we've looked at the marinas.
Let's recap the core narrative for you.
The economy has clearly moved from recovery, that post-COVID scramble to get back on its feet, to expansion and true transformation. We are seeing structural shifts, not just a cyclical bounce.
We are seeing a divergence from global trends, and it seems to be driven by domestic strength in both services and industry, working in tandem.
And here's a thought I want to leave you with, a final, provocative thought. For decades, the world looked at India and saw a labor superpower, a place with lots of people to do work, a billion hands.
Yes. Demographic dividend was the buzzword. The idea was a huge supply of cheap labor.
But looking at all this data, the explosion in patents, the rise of the creative orange economy, the complex consulting work being done in GCCs, the leadership in critical technologies, Are we witnessing the transition of India from a labor superpower to a creative and intellectual superpower?
That is the trillion-dollar question, isn't it? The data certainly suggests that the economic value is increasingly coming from the mind, not just from the hands. It is coming from design, from strategy, from creativity, from innovation.
And if that's true, that changes everything. It changes how you educate your kids, it changes how you invest your money, and it fundamentally changes how you should plan your career.
It implies that creativity and innovation are the new currencies. If you can solve a complex problem, or create a compelling experience, or design a better system, you are in the driver's seat of this new economy.
So here's my call to action for you, the listener. Look at your own industry. Look at your own job. Are you seeing this high-tech or creative shift in your daily work? Are you moving up that value chain from execution to strategy? Because the tide is definitely rising.
And if you're not seeing it in your immediate vicinity, maybe it is time to look around for where the current is flowing. The data is pointing the way.
Exactly. Go find that orange economy gig. Go build a satellite. Or go figure out why air cargo is supposedly up 400%.
Or perhaps just visit a marina and think about it all.
I'm down for the marina. I'll drive the EV there.
Sounds like a plan.
Thanks for listening to this deep dive. We'll catch you on the next one.
Goodbye.
At this stage, it becomes important to assess how these factors influence the economy as a whole.
That's a very calm, I'd say very academic way of putting it. Because when I was going through these sources, specifically Chapter 9 on infrastructure and Chapter 10 on energy, that phrase, factors influencing the economy, it just feels like a massive understatement. We aren't just talking about, a slight change in interest rates or the usual quarterly inflation numbers here, are we?
No, not at all. What we're looking at here is it's the literal physical and, I'd argue, the digital skeleton of an entire nation being re-engineered in real time.
That's exactly how it felt. It read less like a dry economic report and more like, I don't know, a blueprint for a new national operating system.
That's a very good analogy.
You've got this incredible stack of data on everything from, next generation nuclear reactors all the way down to the exact tonnage of copper required for a single wind farm. And the scale of this change, it's not linear. It feels exponential.
Yeah.
But before we dive into all the shiny new projects, I want to sort of push back on the premise a little bit. We've all heard India is building for decades, right? I mean, every government releases a 5-year plan. What makes this specific set of data, this moment in time, different from all the plans we saw in, say, the 1990s or the early 2000s?
And that is absolutely the right question to ask. I think the core difference, the thing that comes through in the data, is a fundamental shift from planning to execution velocity.
Execution velocity, I like that.
In the past, the gap between a project being announced on paper and the actual ribbon-cutting ceremony, well, it could be a decade, sometimes more.
Sure, you hear about a highway, and then 10 years later, you might see the first bulldozer.
Exactly. What these sources are showing us now is a compression of that timeline, a significant compression. And we can actually measure that velocity across 3 really critical vectors: energy security, physical connectivity, and what we're calling the digital layer.
Velocity is the perfect word for it. Because when I looked at the CapEx numbers in Chapter 9, specifically what they call effective capital expenditure, it's not a gentle upward slope on a graph. It's a hockey stick. It shoots straight up. We're looking at a budget estimate of, 15.48 lakh crore for FY26?
That's the number. And that figure is significant, not just because it's enormous, and it is, but because of what it actually represents.
What do you mean?
Well, effective CAPEX isn't just spending. It's not a subsidy that gets consumed and then it's gone. It's expenditure that creates assets.
Right.
It's a bridge. It's a power plant. It's a fiber optic cable being laid in a village. These are, for lack of a better term, force multipliers for the economy that will continue to generate value for 30, maybe 40 years.
Okay, so it's investment, not just consumption. But, and this is where reading the report got really interesting for me, it's not just about throwing money at problems. There are some genuinely surprising twists and turns in these chapters. We're going to talk about the kind of hidden costs of green energy a bit later. And a little spoiler for you listening, solar power isn't as free as you might think when you actually look at the sheer amount of mining required to build a panel.
The resource intensity challenge, as the source calls it? Yes, it's a crucial part of this discussion that, frankly, often gets completely overlooked in the general excitement about renewables.
Completely. And then there's this other massive shift in how the government seems to be approaching business liability. There's a word in there, decriminalization, which sounds like something out of a crime drama, but it's actually a huge, huge deal for anyone trying to start a factory or build something in this country.
It's about reducing friction.
Exactly. So that's our mission for this deep dive, to connect all of these dots. How does 15 lakh crore in spending, a new push for nuclear energy, and these massive digital pipes, how does that all actually translate into real, tangible economic power?
Well, to understand that, you have to start with the engine. You have to start with power. You simply cannot run a high-growth 21st century economy on low-quality fuel or, intermittent, unreliable power. It's impossible.
Right. So let's jump in. Section 1, the energy transition.
Mm.
Or, as I was thinking of it, how to keep the lights on while completely rebuilding the grid from the ground up.
Let's maybe establish a baseline first, because
Yep.
without the context of where we were, the current numbers don't really have the same impact.
Good idea. So where were we?
If you rewind the clock to, say, FY14, the power distribution companies, the discoms, the state-level entities that actually send the electricity to your house or to a factory, they were in a state of near total collapse.
These were the companies that were always in the news for needing bailouts, right?
Bailout is a gentle word for it. It implies they were just struggling. They were hemorrhaging cash. In FY14, the power distribution sector as a whole posted a net loss of roughly 68,000 crore. The precise number is 67,962 crore.
Wait, 68,000 crore in the red? In 1 year. That's not a business, that's a national crisis. How can an economy even function when the companies selling the most essential commodity, electricity, are that broke?
It doesn't function well. That's the short answer. When your distributor is broke, they can't afford to buy power from the generation companies. They certainly can't afford to upgrade aging transformers or sagging wires.
So they just cut the power.
They resort to load shedding, yes, because it's literally cheaper for them to cut your power off for a few hours than it is to buy the electricity they can't afford to pay for. It creates this vicious cycle of inefficiency that drags down every single industry in the country, from a small workshop to a massive steel plant.
Okay, so that's the before picture, system on life support. What does the report say is the after picture?
Fast forward to the numbers for FY25. That massive, crippling loss has turned into a consolidated profit after tax of 2,701 crore.
Hold on, say that again. From a nearly 68,000 crore loss
Yeah.
to a 2,700 crore profit.
Correct.
That's a massive swing. My math isn't great, but that's essentially a 70,000 crore turnaround in the financial health of the grid.
It is a structural turnaround, not just a one-off accounting trick. And it's supported by another really key metric, which is AT&C losses,
AT&C.
aggregate technical and commercial losses.
And in plain English, what's that?
It's a polite term for power theft and bad wiring.
Ah,
It's all the electricity that gets generated but is never actually billed or paid for. That number dropped from over 22%, 22.62% in FY14, down to just over 15% in FY25.
so nearly a third of the leaks have been plugged, the grid is tighter, and the companies running it are actually solvent.
Which means they can finally do the one thing they couldn't do for decades. Reinvest. They can invest in upgrades and smart meters, in better infrastructure. And this newfound financial health, this stability, is the essential foundation for the next big leap the report talks about, which is what it calls the nuclear renaissance.
Okay, this is the part of Chapter 10 that really made me stop and reread the page. The National Nuclear Energy Mission. I mean, we've heard about nuclear power in India for decades. It always feels like the fuel of the future, and it always stays in the future.
Mm-hmm. A common sentiment.
So why does the report seem to suggest we can suddenly jump to a target of 100 gigawatts of nuclear capacity by 2047? That's, what, a more than tenfold increase from where we are today? That sounds like science fiction.
It is incredibly ambitious, there's no doubt about that. But the underlying strategy has shifted quite dramatically. We're not just talking about pouring enormous amounts of concrete for massive, bespoke 1,000 megawatt domes anymore.
So what's the new plan?
The focus is shifting towards technology development, and specifically towards something called SMRs as small modular reactors. The budget has already allocated 20,000 crore specifically for this mission.
I see SMRs mentioned all the time in tech and energy circles, but can you break down the economics of it for us? Why is a small reactor better? Usually in the world of energy, bigger is cheaper because of economies of scale.
That's true for a coal plant, but in nuclear, bigger also means vastly more complex on-site construction. You're effectively building a custom, one-of-a-kind fortress every single time you build a large reactor.
And that's where the delays and cost overruns always happen.
Precisely. It's the on-site work. The permits, the construction errors, the endless safety checks on a unique design, SMRs flip that model on its head. They are, in theory, factory fabricated.
So you build them on an assembly line, like a car.
In a sense, yes, a
Mhm.
highly advanced assembly line. You build the reactor modules in a controlled factory environment to a standardized design. Then you ship them to the site on a truck and essentially plug them in.
That must massively reduce the construction risk and the timeline.
It reduces the on-site construction risk profile significantly, and the target set out in the source material is for these first 5 indigenously designed SMRs to be operational by 2033.
But the technology can't be the only bottleneck, can it? I seem to recall that private players, the big industrial houses in India, have always stayed miles away from getting into the nuclear power business.
They have, and for one very specific, very powerful reason: liability.
The fear that if something, God forbid, goes wrong, they are on the hook for, well, for how much?
Exactly. Under the previous legal frameworks, the liability for a nuclear incident was effectively unlimited for the supplier of the equipment. No board of directors in their right mind would ever sign a contract that says, if this piece of equipment fails, our entire company and all its assets ceases to exist.
It's a complete non-starter for any private business. So how do you solve that? Because the government clearly wants the private sector to help pay for this massive expansion. They can't fund 100 gigawatts on tax money alone.
The proposed solution, as outlined in the source, is a new piece of legislation called the Shanty Act, which was introduced in December 2025.
Shanty. Okay, so what does it actually do? How does it fix this liability problem?
It fundamentally re-architects the distribution of risk. It creates what the report calls a graded liability framework.
Graded liability, so it's not all or nothing anymore.
Correct. It ensures that victim compensation remains paramount. That's the first priority. But it provides legal clarity and a cap on liability for the manufacturers and the operators. It shifts the model closer to something like, say, the aviation industry.
How so?
Well, Boeing is liable if they build a defective airplane. But they aren't liable for infinite damages if an airline, flies it improperly or into a storm. It allows the risk to be quantified, and this is the crucial part. It allows it to be insured.
And the moment you can go to an insurance market and buy a policy for the risk.
The private capital unlocks.
I see.
Precisely. It's a massive signal from the government that it understands it cannot build this future alone. To get the kind of scale you need for baseload power, and you have to remember, nuclear's baseload, it runs 247, unlike solar or wind, you need private capital. And private capital absolutely requires legal and financial certainty.
Speaking of things that don't run 24/7, let's talk about the sun. We've made this huge push into renewables, which is great. But, the sun goes down every night, the wind stops blowing, and that brings us to what the report calls the storage problem.
The intermittency issue? Yes. Yeah. If you look at the projections in the report, it becomes very clear. India is getting very good at generating a lot of green power, but we're not yet good at storing it to make it useful for industry around the clock.
And the requirement cited is just massive. It said India needs 411 gigawatt hours of energy storage by 2031-32.
It's a colossal number.
411 gigawatt. Can you put that in context for us? We're not talking about the battery in your phone. We're talking about vast grid-scale storage farms, right?
We are. We're talking about buildings full of batteries, entire fields of them. And to get there, the policy push has been incredibly aggressive. The report mentions the National Framework for Promoting Energy Storage Systems. But again, as we said before, you have to follow the money. There is a PLI scheme, a production-linked incentive of 18,100 crore dedicated just for 50 gigawatt of ACC manufacturing.
And ACC is advanced chemistry cells.
Yes, batteries, essentially. The key here is that we aren't just planning to import them. The explicit goal of this policy is to create a domestic battery manufacturing sector, basically from scratch.
So the government is literally putting 18,000 crore on the table and saying to companies, we will pay you to build the battery factories here in India.
Yes. Because if you transition your entire economy to depend on solar and wind, but you remain completely reliant on, say, China or other nations for the batteries you need to store that power, then you haven't actually achieved energy security.
You've just shifted your dependency from Middle Eastern oil to Chinese batteries.
You've just swapped one dependency for another.
And that idea, shifting dependency, that is the absolute perfect segue to our next section. Because there was a chart in Chapter 10, a table of numbers that just made me stop and stare. We call it green energy. We think of it as clean, free, almost ethereal. But the report has this very stark heading, the resource intensity challenge.
This is often the aha moment for many people when they really dig into the details of the energy
I
transition.
think so.
We have this mental model where fossil fuels are material heavy. You have to mine tons of coal, you have to drill for oil, and we tend to think of renewables as technology heavy, but somehow material light. The data shows that is, well, it's not entirely true.
Not entirely true. It's putting it very mildly. Let's just walk through the numbers for solar power as laid out in the source. For every single gigawatt of solar capacity you want to build, it requires approximately 18.5 tons of silver.
18.5 tons, and that's alongside 2,000 to 3,000 tons of polysilicon and over 10,000 tons of aluminum.
I'm stuck on the silver. 18 tons of silver for every gigawatt. I mean, that's a precious metal. It's something we wear as jewelry. We use it in high-end electronics. And now we're basically paving the deserts with it to make solar panels.
Silver is the most electrically conductive metal we have, which is why it's so crucial for making solar panels highly efficient. But then you look at wind power. The material intensity there is different, but just as staggering. For wind, it's all about copper.
How much?
A single gigawatt of wind power capacity requires 2,866 tons of copper.
Almost 3,000 tons of copper. And the report had this incredible visualization to help you grasp the scale of that. It said that a single GW of wind power requires about 11,194 truckloads of materials. And they didn't just say truckloads. They specifically mentioned 400-ton capacity trucks. These are not the pickup trucks you see on the highway. These are those monster house-sized mining dump trucks you see in documentaries.
Nearly 1,200 of them, just for the raw materials, for 1 unit of power.
So what we're really saying is that when we talk about green energy, we are, in fact, talking about a massive, massive mining operation.
That is the core economic implication that we absolutely need to grapple with. We are, in effect, swapping a dependency on fuels, things like oil and gas, which you burn, and they're gone for a dependency on minerals.
Right.
Silver, copper, aluminum, lithium, cobalt. These minerals become a permanent part of the infrastructure.
This changes the entire geopolitical calculus, doesn't it?
Yeah.
And it must change domestic policy as well.
It has to, and it does. This is precisely why the environmental governance reforms mentioned later in the source material talk about the need for streamlined mining regulations for what they call critical and strategic minerals.
It connects the dots. If your energy plan requires nearly 3,000 tons of copper for every wind farm, you simply cannot have your domestic copper mines stuck in environmental clearance limbo for 10 years.
It creates a fascinating paradox, doesn't it? To save the environment via green energy, you have to enable more efficient and widespread mining.
It's a trade-off, a huge one.
It is a trade-off. And managing that trade-off intelligently is where things like the circular economy come in, which I'm sure we'll discuss. But at a fundamental level, the Indian economy is shifting from being energy hungry to being mineral hungry. The new constraints on our growth won't be the global price of a barrel of oil, but the global availability of refined copper and silver.
Okay, so we have a plan for the power, and we're beginning to understand the immense material cost of building those power plants. Now we need to move things around. Let's talk about the physical arteries of the economy. Section 3, the physical arteries.
This brings us back to Chapter 9 and the broader infrastructure story. And the headline here, as you mentioned right at the start, is that CapEx graph.
Let's zoom in on that number again.
Yeah.
15.48 lakh crore. It's such a huge number, it's almost abstract. Can you break it down for us? Where does that money actually touch the ground and make a difference?
A very significant portion of it is being channeled into what we can broadly call logistics efficiency. And a great place to start is at the nation's ports.
The report highlights a key statistic here. The average container vessel turnaround time. It dropped from roughly 43.44 hours back in FY15 to just 30.08 hours in FY25. That's a nearly 30% improvement.
It's a huge improvement.
But let me play devil's advocate for a second. Why does the average person listening to this care if a massive container ship leaves the port of Mumbai 13 hours earlier than it used to?
Because time is inventory. And inventory costs money. It's locked up working capital.
Explain that.
Well, imagine you're a small business owner in Ludhiana, and you're exporting textiles to Europe. If your container full of products sits idle at the port for an extra 2 days, you are paying interest on the value of that inventory for those 2 days. That delay, that cost, is baked into the final price of your product.
So it's like a hidden tax on every single thing we try to sell abroad.
Precisely. It's a tax paid in time. So by shaving 13 hours off every single shipment for every exporter in the country, you are effectively lowering the entire cost basis for the export economy. It makes Indian goods that much cheaper on a shelf in Frankfurt or New York without the manufacturer having to slash their own profit margins.
And the report also says that at the same time, the total capacity of these ports has nearly doubled. It's gone from 1,052 million metric tons to 1,602 MMT.
So we're handling significantly more cargo, and we're handling all of it much, much faster.
That's the operating system upgrade you were talking about, moving from a sluggish, laggy system to high-throughput processing.
Exactly. And that same logic, that same focus on speed and throughput extends inland to the roads.
The new highways seem to be everywhere you look these days. The report says the national highway network increased by 60%, from about 91,000 kilometers to over 146,000. But the statistic that was really stark for me was the one on high-speed corridors.
These are the new access-controlled expressways, the ones where you can actually drive at a consistent high speed without stopping for intersections or, cattle crossings.
That network saw a tenfold increase, a 10x jump, from a mere 550 kilometers in FY14 to a projected 5,364 kilometers in FY26.
Think for a moment about what that actually does to the geography of the country.
It shrinks it.
It shrinks it. A truck driver can now cover maybe twice the distance in a single day on one of these expressways compared to an old highway. That effectively brings cities closer together. Markets that were previously too far away to service profitably are suddenly reachable within a single 24-hour delivery window.
What about the railways? I feel like the railways are often seen as the part of the system that's always playing catch-up in India.
They are also accelerating, according to the data. The key metric to look at is commissioning speed. That's how many kilometers of new track are actually built and open for use each year.
And what's the number?
Between 2004 and 2014, the annual average was 1,499 kilometers per year. From 2014 to 2024, that average jumped to 3,118 kilometers per year.
So it's doubled. Again, doubling the velocity of execution.
And when you add all this up, the faster ports, the better highways, the new rail lines, what you are doing is systematically attacking the logistics cost of the economy. For years, the government's stated goal has been to bring India's logistics costs down from the mid-teens as a percentage of GDP to single digits to be comparable with developed economies.
And these numbers, a 30-hour port turnaround, 3,000 kilometers of new rail a year, 146,000 kilometers of highway. This is the nuts and bolts of how you actually achieve that goal.
This is the mechanics of how you get there, yes.
Okay, so we've got the power, we've got the roads and ports to move physical goods. But there's another equally important layer to this modern infrastructure, the invisible layer. Let's move to section 4, the digital and social layer.
The digital backbone, and this is where the transformation is perhaps most personal, most tangible for the average citizen.
The statistics in this section are just mind-boggling. I had to read this one twice to make sure it wasn't a typo. Average monthly data consumption per subscriber. In 2014, the report says it was 0.06 gigabytes.
60 megabytes.
60 megabytes. That's barely enough to download a few emails and maybe a low-resolution photo. You certainly are not streaming video or trying to run a business on 60 megabytes a month.
No, it's a completely different universe of usage.
And in 2025, the projection is 30 gigabytes per month.
That is a 500-fold increase. 500x. And 30 gigabytes is high-definition video streaming. It's constant video conferencing for work. It's running an entire digital storefront from a smartphone in your pocket.
And what about the cost? Because usage usually only explodes like that if the price absolutely crashes.
It has. The report states the current data revenue realization is roughly 8.27 per gigabyte.
8 rupees a gigabyte. I mean, that is arguably the cheapest mobile data on the planet.
It's certainly one of them. And this extreme affordability is the key driver of the usage explosion. But it's really important to stress this isn't just about entertainment. It's not just about people watching Netflix and YouTube.
Right. And the report makes that clear when it talks about PartNet. This is the big government project to connect the gram panchayats, the village councils, with optical fiber, correct?
That's correct. As of the report, 2.15 lakh gram panchayats are now connected.
So what's the economic analysis here? We all know people like having the internet, but how does connecting a village office with fiber actually shift GDP?
Well, think about what we call the gig economy. We usually have this image of an Uber driver in Mumbai or a food delivery person in Bengaluru. But when you have 30 gigabits of data for 8 rupees in a village that's now connected by high-speed fiber,
The game changes.
the game changes completely. You can now have a talented graphic designer sitting in a village in Bihar working for a client in London. You can have digital payments UPI penetrating every last corner of the market, which helps to formalize the informal economy.
It creates a single, Unified digital market. Just like the new highways are creating a single physical market.
That's the perfect analogy. It removes the penalty of distance that has held back rural India for generations.
Now, staying on that theme of rural infrastructure, I want to pivot to something that usually gets put in the box of social welfare. But the report very deliberately treats it as hard economic infrastructure, and that's the Jal Jeevan mission. We're talking about tap water.
It is absolutely economic infrastructure. There's no question about it.
The numbers on the rollout are staggering. 15.76 crore rural households now have a tap water connection. That is up from just 3.23 crore in 2019. That is a massive deployment of infrastructure in just 6 or 7 years.
It is.
But usually we judge a program like this on health metrics. Fewer cases of waterborne diseases, better sanitation. The report seems to focus on a different metric: time.
Think about the time budget or the labor budget of a typical rural household. Before that tap existed, who was responsible for fetching the water for the family?
It's almost always the women and girls in the family. And it usually involves walking long distances, waiting in long lines at a community pump or a well.
It consumes hours per day, every single day. Millions upon millions of female labor hours were effectively lost simply in the act of survival just fetching water. When you install a tap in the house, you aren't just improving health and hygiene, you are handing all of those hours back to the household.
That's a really powerful way to frame it. It's not a welfare payment, it's a massive productivity booster.
It is. That reclaimed time can be spent on more productive agriculture, on taking care of livestock, on starting a small home-based business. Or for the younger girls, it means they can consistently attend school instead of spending their mornings waiting at the well.
And that's long-term human capital accumulation for the economy.
Exactly. You are releasing a massive segment of the potential labor force back into the active economy.
So in that sense, a humble water pipe is just as important as a massive gas pipeline for the nation's economic future.
In the context of unlocking rural productivity, I would argue it's even more important.
Okay, that brings us to the final piece of this complex puzzle. Section 5. We've talked about building the hardware, the roads, the power plants, the fiber optic cables. But what about the software, the laws, the rules, the regulations? Let's talk about governance and finance.
And this is often the hardest part of the equation to change. You can pour concrete much faster than you can change a decades-old bureaucratic culture. But Chapter 10 does highlight some very significant efforts to declog the system.
Regulatory cholesterol. I love that phrase they use. All the gunk that blocks the arteries of business. The report talks about something called Paravesh 3.0.
Paravesh is the government's web portal for all environmental clearances. Version 3.0 aims to be a true single-window clearance system. It integrates permissions, it allows consent to establish and consent to operate to happen through streamlined amendments in the existing Water and Air Acts.
So the idea is, instead of an entrepreneur having to run to 5 different government offices to get permission to, build a factory, they can go to one digital window and get it all done.
That's a goal.
Yeah.
But the bigger, more fundamental shift, I would argue, is the decriminalization effort under what's called the Jan Vishwas Act.
Right. I noted that. The report says it decriminalized a range of minor offenses in the Environment Protection Act, the Air Act, and the Water Act. What does that mean in practice?
Historically, Indian business regulation had a strong tendency to criminalize even minor procedural lapses. If a factory owner, for example, missed a filing deadline for a report or had a minor compliance issue that caused no actual harm, technically, under the old laws, they could face jail time.
Which has to be terrifying for any business owner. The threat of prison for a paperwork error.
It creates what economists call a fear of doing business. It paralyzes decision-making. If you think a simple clerical error could potentially put you in handcuffs, you don't take risks. You don't expand. The Jan Vishwas Act changes that by replacing imprisonment with financial penalties.
So if you mess up, you pay a fine. You don't go to prison.
Exactly. Unless, of course, it's a grievous crime that causes actual environmental harm. But for the vast majority of operational and procedural issues, it shifts the system to a civil penalty model. This actually encourages better compliance because people aren't scared to admit a mistake and rectify it, and it dramatically reduces the scope for harassment.
It sounds like it treats business owners like responsible adults, not potential criminals.
That's a good way to put it. It effectively says, we trust you to run a business, but you will pay a steep price if you break the rules. It reduces the overall risk premium of investing in India.
But investing needs money, a lot of it. And we've talked about the massive costs of this entire green transition, The nuclear plants, the battery factories, the highways. How do we pay for all this? Especially the green shift.
This is where the world of green finance comes in. The financial system itself is being rewired to recognize and value sustainability. The report mentions the issuance of sovereign green bonds.
So these are bonds issued by the government, but the money raised is specifically earmarked for green projects.
Yes, and that allows India to tap into a huge global pool of capital from investors who have specific mandates to only put their money into climate-friendly projects. It can lower the cost of borrowing for these massive infrastructure projects.
And it also mentions green deposits.
Right, that's a framework from the RBI that allows banks to accept deposits from customers that are then earmarked specifically for green lending. So you as a consumer can choose to put your savings where they will support sustainable projects.
And green credits. That sounds a bit different.
That's more on the voluntary disclosure side of things. Under the BRSR core, that's the business responsibility and sustainability reporting framework, large companies can now disclose their green credits. It starts to turn sustainability into a kind of currency, an asset that has value.
And I imagine that links directly back to the circular economy idea you mentioned earlier.
It does. The report lists specific action plans for 10 different waste categories. But think about the concept of extended producer responsibility, or EPR. It's a game changer. It means if you are a company that makes a tire or a battery or a plastic bottle, you are now legally responsible for its end-of-life management.
You can't just sell it and wash your hands of it.
No. And this simple change creates an entirely new market. Waste management becomes a new formal economic sector. You suddenly need companies to collect, to sort, to process, and to recycle all of those materials. Remember the 2,800 tons of copper in that wind turbine?
I do?
Well, when that turbine reaches the end of its life in 20 or 25 years, you want a system in place to get that valuable copper back. You don't want it ending up in a landfill.
So the trash of the old economy becomes the urban mine of the new economy.
Precisely. That is the circular model in a nutshell. It reduces our dependency on fresh mining, which closes the loop on that huge resource intensity problem we started with.
Wow, okay, we have covered a huge amount of ground here. From nuclear reactors to truckloads of silver, from 5G data speeds to household tap water, and from 6-lane expressways to the decriminalization of business laws. Let's try to pull all these threads together. Let's synthesize this.
If we step back and look at the convergence of all these different points, a very clear and powerful pattern starts to emerge.
It really does. It feels like we have the physical roads and ports to move goods faster than ever before. We have the digital pipes to move data and payments instantly to any corner of the country. We have a serious plan for baseload nuclear and renewable power to run our factories. And now we have the regulatory framework, things like the Shanti Act, Paryavesh, the Gan-Vishwas Act, to make building all of this legal, faster, and less risky.
Now, let's revisit the very first thought from the beginning of our conversation. These factors influence the economy as a whole. How do they do it? They do it by systematically removing supply-side constraints.
Supply-side constraints. Break that down for us.
For decades, you could argue that the Indian economy was fundamentally constrained by supply. We always had the demand. We had 1 billion people with aspirations. But we couldn't supply the goods and services they needed efficiently because the power was out, or the road was broken, or the port was congested, or the government permit was stuck on a desk somewhere.
So the thesis is, we are no longer waiting for the power to come back on. We're no longer waiting for the truck to get through the traffic. And we're no longer waiting for the permit to be signed.
That is the core theory of this entire transformation. By removing these millions of friction points, big and small, you allow the economy to run at its natural, inherent speed. And the data suggests that speed is much, much higher than in the past.
It's like we've been driving for years with the parking brake partially engaged, and now someone is finally releasing it.
That's an excellent way to think about it.
But as we wrap up this deep dive, I want to leave you, our listener, with that one provocative thought that we touched on earlier. I just can't get that image out of my head of the 400-ton mining truck.
The resource intensity.
Yes. I want you to just picture that chart again in your mind. 18.5 tons of pure silver for 1 gigawatt of solar. Almost 3,000 tons of copper for 1 gigawatt of wind. As we successfully build out this massive new infrastructure, our economy is fundamentally shifting from being energy hungry, always desperate for oil and coal, to being mineral hungry.
We are in many ways entering the age of the global mining economy.
And the next big geopolitical battle for economic supremacy might not be fought over oil pipelines in the deserts of the Middle East. It's going to be fought over securing the silver mines in Mexico, the copper deposits in Chile, the lithium fields in South America. The question is, are we ready for that? We have plans for streamlining our mining regulations, but do we have secure access to the minerals themselves?
That is perhaps the defining economic and strategic question of the next decade. We have a plan to secure the data, we have a plan to secure the power, but securing the atoms, the physical material needed to build this new world, is the next great challenge.
And on that heavy thought, literally, 11,194 truckloads heavy, we will close this deep dive.
Yeah.
It's a brave, new, and very material world of infrastructure being built around us, and we're just watching the foundation being poured. Thanks for listening.
Thank you. Keep questioning.
Hello, and welcome back to the Deep Dive. I hope you have your climbing gear ready, because today we're not just looking at a single document or a casual study. We are staring up at a sheer mountain of data.
It really is a mountain. It's a comprehensive, almost overwhelming sweep of the social and economic fabric of India. We're talking about thousands and thousands of pages of reports, policy documents, and statistical analysis.
Exactly. I mean, we have piles of reports here covering, well, everything from what a third grader learns in a village classroom all the way to how a gig worker delivering your lunch in Mumbai is legally protected. It's just a massive stack of information on education, healthcare, and labor markets.
And our mission today really is to do the heavy lifting for you. We need to take these distinct pillars, schooling, health metrics, job laws, and synthesize them. We need to try and weave them into a single coherent narrative about human capital.
Human capital, that is one of those MBA buzzwords that usually makes my eyes glaze over. It sounds like we're talking about factory machinery, not human beings. It feels a bit cold, doesn't it?
It does. It does sound cold, I'll grant you that. But stick with me here for a second. When you strip away the jargon, human capital is actually the only economic metric that truly matters in the long run.
The only one.
Well, think about it. You can build the fanciest highways, the biggest ports, the tallest skyscrapers, and we've done deep dives on those infrastructure stacks too. But if the guy driving the truck is sick, or if the engineer designing the bridge can't do basic math, that infrastructure is just concrete. It's dead weight.
So the capital isn't the cash in the bank, it's the capability of the person walking down the street.
Precisely. That's it exactly. The core question we are trying to answer today is this. How healthy are the people? What skills do they actually possess? And this is crucial. How easy is it for them to enter the workforce and contribute? You can build all the factories you want, but if your population is unhealthy or unskilled, the factory just sits idle.
So we're going to look at the life cycle of a worker, essentially.
That's a great way to put it.
From the moment they step into a preschool to the moment they sign a contract for a job.
That is the plan. We'll move from the foundation of education to the fuel of healthcare, and then finally to the engine of the labor market itself.
At this stage, it becomes important to assess how these factors influence the economy as a whole. Because we aren't just looking at social work here, we're looking at the actual engine of GDP.
And that engine, well, it starts firing in the classroom, so I think that's where we should start.
Let's look at the foundation. We're diving into the National Education Policy, or NEP 2020.
The new era of education. That is a big title. But when you look at the sheer scale of the goal, it kind of feels appropriate. The headline target here is universal access. But I have to ask, because we've seen big targets before, is this one realistic?
That is always the right question to ask with these things. The goal is a 100% gross enrollment ratio, or GER, in school education.
100%.
100%. And that covers everything from preschool all the way up to secondary school with a deadline of 2030. So every single child. And just to give everyone listening a sense of the baseline we are working from, because the numbers in India are always, just mind-boggling. We're currently talking about roughly 25 core students.
It is a staggering figure. 25 core students enrolled in about 14.7 lakh schools. And keeping that system running are over 1 crore teachers. I mean, it's a population larger than most European countries just sitting in classrooms every single morning.
Getting them in the door is one thing. Keeping them there is another, right?
Yeah.
I seem to remember reading that dropouts were a huge issue historically.
They still are a challenge, absolutely, but the pattern is specific. The data shows that the gross enrollment ratio is already quite high for the younger years. We're talking over 90% for grades 1 through 8.
Oh.
So we've gotten really good at starting. But the numbers, they start to dip as the kids get older. It drops to about 78.7% for grades 9 and 10, and then it drops again pretty sharply down to 58.4% for grades 11 and 12.
Wow. So nearly half the kids are gone before they finish high school. That is a massive leak in the pipe.
It's a huge leak, so the challenge isn't just starting school anymore, it's finishing it. And that same challenge extends to higher education, too. The aim there is to hit 50% GER by 2035.
And where are we now?
For context, in 2022-23, that number was sitting at 29.5%. So we are looking at nearly doubling the percentage of young adults in college or university in just over a decade.
That's a massive expansion.
Yeah.
But let's unpack the how, because getting kids in seats is one thing, but if they are just sitting there staring at a chalkboard, memorizing dates and names, are they really learning?
Yeah.
The NEP seems to be trying to shift the actual structure of learning. I keep seeing this formula everywhere. 5 plus 3 plus 3 plus 4.
Yes, that's the core structural shift.
Okay, let's unpack this. 5 plus 3 plus 3 plus 4. It sounds like a football formation or something. To be honest, when I first saw this, I thought, great, more bureaucratic shuffling. Does it actually matter if we group grades differently? Is this just rebranding?
That's a fair question, but it's definitely not just rebranding. It's actually based on neuroscience.
Neuroscience in a government policy document.
Yes, really. Look at the old 10+2 system we all grew up with. It effectively ignored everything before grade 1. It just assumed formal education starts at age 6. But the data and the biology tells us that 85% of a child's cumulative brain development happens before the age of 6.
85%. Wow, so by the time they hit first grade in the old system.
The critical window was already closing. The new 5 in that 5 plus 3 plus 3 plus 4 formula covers ages 3 to 8. It brings preschool things like anganwadis, balbatikas into the formal curriculum for the very first time.
So they aren't just playing with blocks. They're actually building the neural pathways for literacy and numeracy down the line.
Exactly. But, and this is a really key point, it's not about forcing a 3-year-old to write essays. The policy is very, very specific about play-based learning.
Right.
It's acknowledging that for a 4-year-old, playing is learning. The old system tried to force rote memorization way too early. This new structure is trying to fix what they call the foundational crisis.
And that leads directly to this FLN acronym I see everywhere, Foundational Literacy and Numeracy, which is basically, can you read and can you do basic math?
Right. It's as simple as that. And this is where the NIPUN Bharat initiative comes in. The research on this is crystal clear. If a child can't read by grade 3, they will struggle to learn anything else for the rest of their lives. It's a critical bottleneck.
I've heard it put this way. Before grade 3, you are learning to read. After grade 3, you are reading to learn.
That's it, exactly. If you miss that switch, you're lost. You can't learn history from a textbook you can't read. You can't solve a word problem in math. Everything stalls.
So do we have any data on whether this new focus is actually working? Because policies are great on paper, but are the kids actually reading better?
We actually do. The sources cite the Para-H 2024 report. It's a huge assessment that measures proficiency at grade 3, and the jump is pretty significant. In 2021, language proficiency was at 39%.
Okay, so less than half.
Less than half. By 2024, it hit 57%.
Wow, that's almost a 20-point jump in just 3 years.
It is. And in math, it's even more dramatic. It went from 42% in 2021 to 65% in 2024.
So 2/3 of kids are now proficient in math at that grade level.
Right. Now, is it 100%? No. We still have a long, long way to go, but the trajectory is undeniably upward. It suggests that this specific focus on foundational skills, on just getting the absolute basics right, is paying off.
That's really promising. Now, here's where it gets really interesting for me, the technology aspect.
Yeah.
We always hear about EdTech, but usually it's about private companies selling subscriptions and apps. The government seems to be rolling out some pretty sci-fi sounding tools here. The one that caught my eye is the APA ID.
Yes, the Automated Permanent Academic Account Registry.
It's a mouthful, but the concept is just so cool. It's essentially an educational passport for life, right?
That is the perfect analogy. Think of it as a lifelong digital backpack. Right now, the system is incredibly fragmented. If a student moves from a village school in Bihar to a city school in Mumbai, their academic history usually gets lost. It involves carrying around a stack of physical papers that get lost or damaged. Or if you move from school to, say, a vocational training center, those two systems don't talk to each other at all.
So your history basically gets erased every time you move.
Exactly. The APRID is designed to track a learner's progress across the entire ecosystem: school, higher education, skills training, everything. It creates a single, unified record of your human capital accumulation.
So if I learn a new skill in a short-term course, like, say, data analytics, it gets logged in my passport right alongside my university degree.
Correct. It makes everything portable. It facilitates credit transfers between institutions and makes the labor market much more efficient because employers can verify skills almost instantly. No more fake degrees, and no more lost credentials.
That's a game changer. There's also mention of the Vidya Samiksha Kendra. It sounds like a mission control center from a NASA movie.
That is exactly what it is. It is the monitoring brain for the entire education system. It's a system designed to track learning progress in real time.
In real time.
Well, close to it. Instead of waiting for an end-of-year exam to realize that, a particular district is falling behind in math, this system allows for timely intervention. If data shows a sudden drop in attendance or a dip in performance in a specific area, the system flags it immediately for administrators.
So it's data-driven school management on a national scale. I like it.
Yeah.
But let's be real. In a country as diverse as India, the biggest barrier isn't always data. It's language. We have so many languages. A kid might be brilliant, but if the textbook is in English and they speak Marathi at home, they're going to struggle.
Yeah.
How does the NEP handle that?
This is one of the real aha moments in the documents for me. For decades, the approach was to try and force uniformity, usually in English or Hindi. Now, they're using technology to break that barrier down.
House.
The source mentions that over 3,000 AI-driven interactive e-content pieces are now available in multiple Indian languages.
So you have AI translating lessons on the fly, so a kid can learn physics or biology in their mother tongue.
That's the idea. And under the Bharatiya Bhasha Pustak scheme, there are digital study materials in 22 different Indian languages. This is absolutely crucial for inclusivity. If a child understands the concept in their home language, they learn it. If they have to struggle with the language of instruction first, they fall behind on the concept too. It's a double penalty.
It seems like the walls around the education system are really starting to come down. Language walls, structural walls, and I see a note here about national walls too. Internationalization.
That is a major policy shift, a huge one. For the first time, 100% foreign direct investment, or FDI, is now allowed in higher education. And the documents say 15 foreign institutions are expected to set up campuses right here in India.
So you could technically attend a global university, get a degree from a top-tier foreign institute without ever leaving the country.
That is the goal. It does two things. First, it helps keep talent within the country. It's a direct counter to the brain drain problem. And second, it upgrades the quality of competition and collaboration in the higher education sector. It forces local universities to up their game to compete.
So let's just pause for a second and look at the picture we've painted so far. We have a student who is learning in their own language, they're tracking their progress with a digital ID, and they're developing critical thinking skills thanks to a neuroscience-backed curriculum. But, and this is a massive but, all of that potential is completely wasted if the student is too sick to go to class.
Which brings us directly to the second pillar, healthcare. You simply cannot build a strong economy on the back of a sickly workforce. Health metrics are, in a very real and measurable sense, economic indicators.
Okay, so let's look at the big numbers first. Life expectancy. This is usually a really slow-moving number, isn't it? It takes generations to shift.
Usually, yes, it's like turning a giant ship. But looking back a few decades shows you how far India has come. In 1976, life expectancy was 49.7 years.
Under 50.
Under 50. Just think about that for a moment. The average person didn't make it to their 50th birthday.
That is incredibly young. That basically means you work for a few years, you raise your kids, and then you're gone. The productive period of your life is so short.
Exactly. Now, fast forward to 2023, and life expectancy has leaped to 70.3 years. That is a massive gain over 20 years of life added in just a few generations.
And from a purely economic perspective, that changes everything.
Completely. A longer living population stays in the workforce longer. They accumulate more experience, more wisdom, and they contribute to the economy for decades more than their grandparents ever could. It totally transforms the concept of a career. You aren't just sprinting to 50 anymore. You are running a marathon to 70.
The infant mortality rate, or IMR, has also dropped significantly over the past decade. But I want to talk about what people are eating. We often hear about hunger, but the data here shows a really interesting shift in nutrition.
Yes, the data on intake is fascinating. It shows a steady rise in both per capita protein and calorie intake in both rural and urban areas. For example, if you look at rural areas, protein intake went from about 59.3 grams per day in 2009-10 to 61.8 grams in 2023-24.
It's not a huge jump, but it's consistent.
It's a consistent upward trend. So generally, people are eating more and eating better. But that brings its own set of problems, doesn't it? The so-called lifestyle diseases.
Right.
We are seeing a classic shift from not having enough food to having the wrong kind of food.
Right.
It's often called the double burden of malnutrition. As undernutrition recedes in some areas, you see obesity and lifestyle-related issues like diabetes and heart disease rise in others. The government seems very aware of this. There are specific campaigns mentioned in these documents like Eat Right and Aji Seda Kam Kam, which basically means a little less from today.
I love that slogan, just eat a little less. It's so simple, it sounds like something your grandmother would say.
But it's backed by policy and very specific initiatives like the campaign for a 10% reduction in oil consumption. It's targeted behavioral change to prevent things like heart disease down the road.
Speaking of behavioral change, there is a surprising focus in here on digital well-being. I honestly didn't expect to see screen time mentioned in a government economic document. Usually they want us to be more digital, not less.
It shows how the definition of health is evolving, It's not just about physical health anymore. The government is actively focusing on combating digital addiction. They have released something called the Pragyata Framework for Screen Time Planning in Schools.
And then there's the Shut Clinic at Numbum Hands. I had to look this up.
The Service for Healthy Use of Technology, it's a specialized clinic for technology addiction.
That is fascinating and probably very necessary. I mean, we are all glued to our phones. If the workforce is just scrolling Instagram all day, productivity absolutely tanks.
Exactly. And for mental health specifically, there is Telemanas. It's a 247 national helpline. 14416 is the number. It's a huge step. It acknowledges that mental health is a part of human capital just as much as physical health is. If you are anxious or depressed, you aren't working at full capacity. Period.
Now, we can't talk about Indian healthcare without talking about Ayushman Bharat. The scale of this program is always just so hard to wrap my head around.
It is the world's largest government-funded healthcare program. I mean, nothing else even comes close. The source indicates there are over 1.8 lakh Ayushman Arogya Mandirs operational now. These are the primary health and wellness centers.
The first point of contact? And the footfall, the number of visits.
This number is just staggering, a footfall of 506.50 crore. Now, that represents cumulative visits, obviously not unique individuals, but it shows the sheer volume of care being delivered at the grassroots level. And over 42 crore Ayushman Heart cards have been generated.
But help me understand the direct economic impact here. I get that it's good for people to see a doctor when they're sick, but how does this boost the economy as a whole?
It's about preventing the poverty trap. In developing economies, one of the biggest single causes of a family falling back into poverty is a health shock. A catastrophic health event.
Right.
A family is doing okay, maybe they're middle class, then the main breadwinner gets sick. They have to sell their land, they sell their assets, they take out loans to pay the hospital bill, and just like that, they're back to zero. Ayushman Bharat acts as a financial shield against that.
So it prevents the bankruptcy that comes from getting sick.
Exactly. And if a family doesn't go bankrupt paying for a hospital visit, they can keep spending, keep investing, and keep educating their children. It protects human capital from being wiped out by a random illness. It's a massive economic stabilizer.
They're also using AI here, just like in education. I'm seeing a pattern.
Yes, there's a big push for it. The documents mention AI-driven reforms at AIVS, and specifically AI-based screening for diabetic retinopathy. That's a perfect use case for AI using an algorithm to scan thousands of eye images and catch blindness-causing conditions early, something which human doctors might miss or simply not have the time to screen for at that scale.
So we have a healthier population, living longer, protected from financial ruin, with a digital education passport. Now they need to work. Let's move to the engine, the labor market.
This is where the rubber really meets the road. And honestly, for a long, long time, India's labor laws were, well, labyrinthine is a polite word. Regulatory cholesterol might be a better one.
Complex is an understatement. I've heard horror stories from friends who run businesses needing dozens of licenses and registrations just to open a door.
We are talking about 29 different central labor laws, some dating back decades, all with different rules, different definitions of what a wage is, and different compliance requirements. It was a complete spaghetti bowl of regulation. The big reform here is consolidation.
Right, rolling them all into just 4 codes.
Exactly. The code on wages, the code on social security, the code on occupational safety, and the code on industrial relations. Much simpler.
What's the philosophy behind this, though? Is it just to save paper and make life easier for lawyers?
No, it's a much deeper philosophical shift. The goal is to balance worker protection with flexibility for businesses. In the past, the laws were so rigid that businesses were actually afraid to hire formal employees because they knew they could never let them go if the market turned. So what did they do? They stayed small or hired informally off the books.
You mentioned this term dwarfism in the notes. It sounds like a medical condition, but we're talking about factories. What is economic dwarfism?
It's a fascinating and frankly self-inflicted wound on the economy. Imagine you run a small textile factory. You have 90 employees, business is booming, and you get a massive new order from an overseas buyer. To fulfill it, you need to hire, say, 20 more people.
Great problem to have.
Yeah.
So I hire them, I have 110 employees, my business grows, everyone wins.
In the old system, you lose. The moment you crossed the 100-employee threshold, the old Industrial Disputes Act kicked in with full force. Suddenly, you couldn't lay anyone off without explicit government permission, which was almost never granted. You were essentially married to that workforce size forever, regardless of whether the market crashed next year.
That sounds incredibly risky. So if I hire those 20 people to meet the order, and then the order gets canceled 6 months later, I'm just stuck paying them until I go bankrupt.
Exactly. So what did the rational business owner do?
I stay at 90 employees,
Mm-hmm.
I turn down the big order, or I outsource it to a bunch of tiny unregulated workshops.
Precisely. You stay a dwarf. You intentionally keep your business small to avoid the regulatory headache. This is one of the big reasons why India has millions and millions of tiny firms and very few mid-sized ones. The new labor codes are raising that threshold to 300 employees.
So I can grow to 299 employees without that existential fear. That is a massive psychological shift for a business owner.
It is, and it's paired with another huge change that recognizes the modern economy: the gig workers.
This is huge. The delivery drivers, the cab apps, the freelancers. For a long time, they were in a total gray area, right?
They were completely invisible to the law. They weren't employees, but they weren't exactly independent contractors either. For the first time, gig workers are getting formal recognition in the law. This is a major, major modernization step. The codes propose creating a Social Security fund specifically for them.
So my Uber driver, or the person who delivers my food, might actually get Social Security benefits in the future.
That is the plan. They aren't just partners or freelancers anymore. They are being brought into the formal labor ecosystem. And to manage all this mobility, there's the Universal Account Number, or UAN.
Is that like the education ID we talked about earlier, the APAR ID?
Very similar concept. Just like the APAR ID for students, the UAN allows for the portability of benefits. If you move from a job in Mumbai to a job in Delhi, or if you switch from being a factory worker to a gig worker, your Social Security benefits travel with you in one account. You don't have to close one account and open another 10 times in your career. It removes the friction of moving jobs.
I also noticed a subtle but important change in the language regarding enforcement. They're calling them inspector cum facilitator. Now, I have to be a little skeptical here. Changing a title doesn't automatically change a culture. Is a name change really going to stop harassment and corruption?
It's a fair skepticism. In the old License Raj era, the labor inspector was a figure of fear, someone who came to your business to police you, find some minor violation, and, extract a bribe. The new code attempts to rebrand them as facilitators. Their job is theoretically to guide businesses on how to comply, not just punish them for non-compliance.
Theoretically being the key word there.
True. Implementation is everything. The culture change will take time. But the intent is to shift from a policing mindset to a compliance mindset. To help with that, they've also introduced single registration and single licensing for many businesses.
Which again, just reduces the paperwork and the number of touch points for potential corruption.
Exactly. And the theory is, if firms can grow more easily, they will hire more. The projections cited in the documents from SBI suggest that the full implementation of these codes could result in the creation of approximately 77 lakh jobs.
77 lakh jobs. That is a huge injection into the economy. And looking at the current stats, the labor force participation rates, the LFPR, is hovering around 55–56%, with unemployment stable around 5%. So we have a steady base, but we really need that growth.
And the biggest source of that potential growth, it's not just general population growth. It's a specific demographic that has been, for a long time, historically underutilized in the Indian economy.
Women.
Exactly. And this brings us to Section 4, the catalyst, female labor force participation.
This has been a really tough sticking point for the Indian economy for a long time. The numbers were actually falling for years, weren't they?
They were. It was a puzzle for economists. But recently, we've seen a surge, a really dramatic surge. In 2017-18, the female labor force participation rate was just 23.3%.
That is quite low globally.
Very low. But by 2023-24, it shot up to 41.7%.
That is nearly doubling in 6 years.
That is an
Yeah.
incredible turnaround. And female unemployment dropped from 5.6% to 3.2% in the same period.
Mm.
So not only are more women looking for work, but more women are finding it. What changed? Is it just the economy growing in general, or is it specific policy?
It's a combination of legislative changes and on-the-ground safety initiatives. The barriers are being dismantled one by one. Let's talk about the legal barriers first, because some of them were frankly, well, a bit absurd in the modern age.
Give me an example.
Okay, we'll take the night shift. As of now, 22 states and union territories now permit night work for women in factories.
Wait, hold on. It was illegal for a woman to work at night.
In many places, yes. Under the Old Factories Act of 1948, women were prohibited from working between 7 p.m. and 6 a.m. It was written with a protective intent to keep them safe, but in practice, it meant that IT companies or modern manufacturing plants just wouldn't hire women for certain roles because they couldn't be rostered for the night shift.
So they were basically protected right out of a job.
Exactly. Now, that restriction is gone, with the condition that employers must provide adequate safety measures. 17 states have also removed prohibitions on women working in so-called hazardous industries, again, shifting the focus from blanket exclusion to ensuring proper safety protocols for everyone.
But you can't just change the law. You have to change the environment. If I'm a woman who's being asked to work a night shift, I need to know that I can get home safely.
That's a huge factor. And the sources highlight some specific urban initiatives that are tackling this. Kochi has a dedicated women police control room. Hyderabad has the Shani Team's specialized police units focused on women's safety in public spaces. Chennai has even developed an inclusive street design manual to make public areas safer.
And housing, that's another huge one. If you get a job in a big city, where do you live? Migration is scary, especially for young women.
Exactly. Migration is so much harder for women if safe housing isn't available. The source mentions programs like Saki Niwas and the Tozi hostel model in Tamil Nadu. These provide safe, affordable accommodations specifically for working women. It dramatically lowers the barrier to entry for a woman who wants to move from her village to a tech hub for a job.
And then there's the whole care economy. Because let's be honest, the burden of childcare still disproportionately falls on women. If there's no one to watch the kid, the mom often has to stay home.
It does, and the new Social Security Code recognizes this. It mandates crèches in establishments with a certain number of employees. You also have the expansion of the Anganwadi system. If a mother knows her child is in a safe and caring environment, she can enter the workforce. If not, she stays home. It's often that simple.
There are also some interesting public-private models mentioned here, something called Telangana's WE Hub. What's that?
WeHub is really unique. It's a state-led incubator exclusively for women entrepreneurs. It provides funding, mentorship, and support. And then you have something like Kerala's Kudumashri, which is this massive network of neighborhood groups that empowers women economically at a very local level. So these aren't just jobs. These are platforms for women to create their own economic destiny.
It really feels like a convergence of all these different factors.
Mm-hmm.
Safety, housing, childcare, and the law all moving in the same direction.
That's why we call it a catalyst. When you unlock this massive potential, you aren't just adding more workers to the economy. You are adding a different perspective, different skills, and you're boosting household income significantly across the board.
Okay, so we have the people, we have their health covered, we have the new labor laws, and we have more women joining the workforce. But there's one final critical piece of this puzzle: skills. You can have a degree, but can you actually do the job? We hear about the employability gap all the time, graduates who can't code or engineers who can't fix a machine.
This is the bridge. The final piece connecting education to actual employment. Because you're right, there is often a huge mismatch. What universities teach isn't always what industries actually need.
The document mentions modernizing ITIs, the Industrial Training Institutes. Now, when I think of an ITI, I have to be honest, I think of a dusty old workshop with 50-year-old lathes.
And that is the exact image they are trying to shatter. The plan is to modernize 1,000 ITIs across the country. And we aren't talking about just a new coat of paint. We are talking about smart classrooms and even AR/VR labs.
Augmented reality for vocational training, like for a plumber or an electrician.
Absolutely. Imagine learning to weld or repair a complex jet engine using a VR simulation before you ever touch the real expensive machinery. It's safer, it's cheaper, and it's often more effective. It gamifies the learning process and lets you practice 1,000 times without risk.
And this is part of PMKVY 4.0.
Yes, the Pradhan Mantri Kaushal Vikas Yojana 4.0. The key here is that all this new training is aligned with the National Skills Qualifications Framework, the NSQF. It's about standardizing skills so that a certification in welding from an IPI in one state is recognized and valued everywhere else.
But here's where the money part gets really, really innovative. I saw this term, skill impact bonds. I have never heard of this. It sounds like something from Wall Street, not a government skilling program.
It is a fascinating financial instrument. Traditionally, the government pays a training provider, let's say a coding boot camp, to train 100 students. The government pays up front. The provider trains them, gets paid, and, well, maybe the students get jobs, maybe they don't. The provider's job is done.
Right. The incentive is just to run the class and get the bodies in the chairs. There's no incentive for quality or for actual job placement.
Exactly. The risk is all on the government and the student. With skill impact bonds, private investors put up the money up front to the training provider. The training provider only gets the full payment, and the investors only get their return if the student gets certified, gets placed in a job, and, this is the crucial part, retains that job for a certain period of time.
Wow. That completely flips the incentive structure. Now, the training provider has a vested financial interest in making sure the student is not just trained, but is actually employable and successful.
It's smart money. It's paying for results, not just for activity. It forces the training providers to be in constant conversation with industry to make sure they're teaching relevant skills.
There's also skill vouchers. This sounds a lot simpler, almost like giving people a coupon for education.
That's basically what it is, yes. This puts the power and the choice in the hands of the learner. Instead of the government telling you, you must go to Institute X, they give you a voucher. You can choose where to spend it. It forces training institutes to compete for students by offering better quality and better outcomes. The source mentions Maharashtra's Vikalp program as a good example of this.
And finally, apprenticeships. This seems like the oldest form of skilling in the world, the master and the apprentice, but it's getting a tech upgrade here too.
It is. Under NAPS 2.0, which is the National Apprenticeship Promotion Scheme, they are using direct benefit transfer, or DBT. The government transfers 25% of the apprentice's stipend directly to their bank account.
So the employer pays the other 75%.
Yes. It lowers the cost for the employer to take on an apprentice, making them more likely to do so, and the DBT ensures the money actually reaches the trainee without any leakage or delays. It just makes the whole system smoother and more frictionless.
You know, it really seems like the common theme across all of these sections, from education to labor, is removing friction.
That is a great observation. I think you're spot on. Whether it's removing the friction of transferring schools with an APA ID, removing the financial friction of a health shock with Ayushman for it, removing the regulatory friction for businesses with the labor codes, or the financial friction of skilling with these new models, it's all about greasing the gears of the economy to let it run more efficiently.
So let's zoom out. We've climbed this mountain of data. What does the view look like from up here? What's the big picture?
If we synthesize this whole narrative from the classroom to the workplace, we are looking at a profound and I think intentional transformation of the Indian human capital landscape.
We started with a child entering a multilingual classroom, supported by the actual neuroscience of the NEP.
Then we ensured they were healthy, checking their nutrition and screening their eyes with AI while protecting their family from a devastating financial shock if they got sick.
We gave them a skill voucher to learn a trade or an APA ID to carry their academic credits with them to university and beyond.
And then we welcome them into a modern labor market that actually recognizes their rights. Whether they are a gig worker delivering packages on a bike or a woman working the night shift in a high-tech factory.
It's a complete ecosystem. And the so what here, the takeaway for the economy, is pretty clear.
The so what is that these aren't just nice-to-have social programs. They are hard economic levers. You increase the quality of your labor force, you increase their health and longevity, and you increase the ease with which they can work and switch jobs. That leads directly to higher productivity, higher consumption, and ultimately higher GDP. This is how you build a developed nation, not just with concrete and steel, but with people.
It is a very compelling picture. But before we go, I want to leave our listener with a final thought. The question really that's been nagging me as we've talked about gig workers and skill vouchers and lifelong learning.
Go for it.
We used to think of a career as a straight line. You graduate, you join a company, you stay for 30 years, get a gold watch, and then you retire. The classic 9-to-5 model.
That was the 20th century model, for sure.
Exactly. But with everything we've discussed today, with all this flexibility and portability, are we witnessing the end of that? Are we moving toward a much more fluid lifetime of work?
where you learn a skill, you work a gig for a few years, you upskill again with a voucher, you switch industries entirely.
That is the provocative question, isn't it? The infrastructure we've just discussed, the portability of benefits with UAN, the lifelong learning IDs with APA, it all seems designed exactly for that fluid future. The real question is, are we ready for it mentally? Is society ready to embrace a world where stability comes from your portfolio of skills, not from your employer's name?
A fluid, skills-based lifetime of work. That is definitely something to mull over. Thank you so much for joining us on this deep dive into the human engine of the economy.
My pleasure. It's been a fascinating discussion.
And thank you as always for listening. We will catch you on the next deep dive. At this stage, it becomes important to assess how these factors influence the economy as a whole.
It really does. Because, we usually have these conversations in total isolation in these neat little silos.
Completely. We talk about farming and the rural economy over here.
Right, and it's almost always framed as a social issue, a welfare issue.
A charity case,
Yeah.
almost. Then you have the AI ecosystem, which is discussed by a completely different set of people, almost as if it's this shiny object floating in the cloud, disconnected from everything else.
Exactly. And then, in our daily lives, we complain about city traffic as if it's just a personal nuisance, a daily annoyance.
Not a massive systemic economic drain.
A massive drain. And when you stop looking at them as separate line items on a spreadsheet and you start looking at how they collide, how they interact, the whole picture just changes completely.
And that is exactly what we're planning to do today. Welcome back to the deep dive. We are taking a whole stack of sources that, on the surface, look like they belong on 3 different desks in 3 different ministries.
They seem totally unrelated.
Totally. We have these very detailed reports on rural land digitization. Now, that sounds incredibly dry, but I have a feeling it might be the biggest story here. Then we have a strategic framework document on India's AI rollout. And finally, some pretty damning data on urbanization, city density, and mobility.
It does sound like a disparate mix. You wouldn't normally read these 3 things in the same sitting.
It wouldn't. But the whole premise of today's deep dive, and this is what I want to challenge you on as we go through it, is that these are not 3 separate stories.
No.
They're one story about a huge structural transformation that's underway.
Exactly. And if you look closely at the source material, there's a mission, or a theme you could call it, that runs through all of it. And it's this idea, this shift from participation to partnership.
Okay, let's unpack that distinction for a minute. Participation versus partnership. What's the real difference there?
Well, think of participation as just showing up. It's passive. The government builds a road, and you, the citizen, you drive on it. You're a user, a beneficiary.
I'm just receiving a service.
You're receiving a service. Partnership, in the context of these documents we're looking at, means the citizen becomes an active stakeholder. They have skin in the game. They own the asset. They generate the data. They help manage the city's waste. It's a fundamental shift in the relationship between the state and the individual.
So it's about optimizing assets.
It's all about optimizing assets. We're looking at 2 big categories here. First, optimizing physical assets, like a parcel of land in a village or the floor space in a city building. And second, optimizing digital assets, like the mountains of data coming from 1 billion connected people.
And the argument, I guess, is that when you get that physical engine and the digital engine running in sync, that's when the economy actually takes off.
Precisely. It stops being a collection of sputtering, disconnected parts and turns into a single, unified economic engine.
Okay, I'm intrigued. But I want to start where the economy literally starts, which is on the ground, the soil. Let's start with what the sources are calling the rural economic reboot.
The foundation. Makes sense.
Yeah, the foundation. And the phrase that really jumped out at me from the source material is this shift from aid to asset management. Now, let's be honest. Typically, when we discuss rural development, the subtext is always welfare. It's about subsidies. It's about handouts.
It's about poverty alleviation, keeping people afloat.
Exactly. And that has been the dominant model for decades. Here's some food, here's some fuel, here's a small cash transfer. And that's all maintenance. It keeps people from starving,
Yeah.
but it doesn't necessarily make them wealthy or productive.
It puts a floor under them, but it doesn't build a ladder for them.
That's a great way to put it. What's so fascinating about the reports we're looking at today specifically regarding this thing called the SBMTVS scheme,
Mm.
is that they completely flip that logic. They're not talking about giving people things. They're talking about documenting with incredible precision what people already have.
And this goes right to the heart of the dead capital concept, right?
Explain that for us.
It's an idea from the economist Hernando de Soto. And his core argument is that the poor aren't actually poor in terms of assets. They have assets. They have houses, they have small plots of land, they have livestock. The problem is that these assets are, in his words, dead.
What does that mean, dead? It means they're invisible to the formal economy.
Completely invisible. So imagine you're a farmer in a remote village. You live in a house your grandfather built. The whole village knows it's your house. Your neighbors respect your boundary line. Socially, you own it. It's yours.
Right.
But then you walk into a formal bank in the nearest town and say, look, I want a loan for 5 lakh rupees to buy a new tractor, and I'll use my house as collateral. The bank manager, very reasonably, asks for the title deed, the property papers.
And you don't have one. You have nothing but oral tradition and the respect of your neighbors.
You have nothing the legal or financial system recognizes, so the bank manager has to say no. To the entire financial system, your house, that very real physical asset, effectively doesn't exist. It has zero value. It's dead capital.
So SVMITVIA is the resurrection of that capital.
That's a dramatic way to put it, but yeah, that's basically it. And the data point here, the scale of it is just huge. 3.28 lakh villages mapped. And we need to be clear about how they're doing this. They aren't just sending surveyors out with tape measures and clipboards.
No, this is the part that gets me. They're using drones. We usually associate drones with, warfare or maybe high-end wedding photography. But here, they're flying drones over villages to create millimeter-accurate digital maps of every single property line.
It's an incredible application of modern technology to solve a very old problem. And the output of all this high-tech mapping is a simple, tangible thing, the property card. And the source says 2.76 crore of these cards have already been issued.
Okay, but let me play devil's advocate for a second. Does a piece of plastic with a QR code on it really change the economic reality for a family? Just because I now have a card, does the bank suddenly trust me? Is it really that simple?
It's not about trust, it's about risk. From the bank's perspective, without that card, the risk of lending against that property is infinite. There could be a dozen cousins who claim ownership. The boundaries could be disputed. With the card, which is backed by a government drone survey, that risk is quantified and minimized.
I see. So the asset becomes liquid.
It becomes leverageable. The source material is very clear that this monetizes rural land at a massive scale. Once that land is in the formal system, you can borrow against it. You can sell it without a 5-year dispute with your neighbors. You can use it to invest in your children's education or a small business. Suddenly, that farmer isn't just a laborer. He's an asset owner. That is a fundamental psychological and economic shift.
And it creates a formal tax base for the village panchayat too, I'd imagine.
A huge point. The village can now actually raise its own revenue because it knows who owns what. But that's a whole other rabbit hole.
We'll get there. Speaking of drones, there's another layer to this tech as a multiplier theme in the sources. It's not just the government flying these mapping drones, it's the people themselves. Specifically, an initiative called Namo Drone Didi.
I love this example. It's so clever.
The stats are modest on the surface. 500 drones provided in the 2023-24 period. Now, compared to the population of India, 500 sounds like a rounding error. So why is this significant?
It's significant because of who is being trained to fly them. The Didis. These are women in rural self-help groups.
Right, so you're taking a demographic that is often the most economically and socially marginalized rural women, and you're handing them the keys to the most advanced piece of technology in the entire village.
Exactly. I mean, think about the traditional power hierarchy in a village. Who holds the power? It's usually men, and it's usually the men who own the most land. Now imagine a woman from a landless family who is a certified trained drone pilot.
She controls the technology.
She's the one who gets hired to spray fertilizer with the drone because it's more efficient. She's the one monitoring crop health from the air. She becomes a high-skill, in-demand technician.
It must completely disrupt the old social structure.
And the economic structure. It's creating what the source calls a tech-driven initiative layer. It's not a handout. It's the creation of a brand new service economy within the village itself. Farmers pay the drone Didi for her services. Money circulates locally. It's a perfect example of labor augmentation, not replacement.
And the sources also mention these rootage smart village centers. Things like solar power, telemedicine. This seems to be a coordinated attack on what you could call the friction of distance.
That is the perfect phrase for it, because poverty so often is just a function of distance. If you get sick, the cost isn't just the 10 rupees for the medicine, it's the full day of wages you lose traveling to the town. It's the bus fare. It's the hours spent waiting in a queue.
It's the time tax.
It's a huge time tax. If you have a telemedicine center in the village where you can consult a doctor in a city hospital over video, you collapse that distance. You erase that time tax.
You save the lost day of wages.
Right. And then you look at the broader infrastructure stats in the sources, what we call the stats blitz in our prep, and it starts to paint a picture. Connectivity for eligible habitations is over 99.6%. The Har Ghar Jal scheme, putting a tap in every home, is at over 81% of rural households. Over 2.9 crore houses constructed under the rural housing scheme.
Okay, but again, the skeptic in me asks, building houses is great, people need roofs.
Yeah.
But is it an economic driver, or is it just a one-time burst of construction spending?
Oh, it's a massive productivity driver. Think about the time tax again. If a woman in a household spends 2 hours every morning walking to a well or a hand pump to fetch water for the day.
Which millions still do.
Millions. That is 2 hours of potential economic productivity that has just vaporized. Every single day. If a family has to spend its meager savings patching a leaky roof every single monsoon, that is capital that isn't going into their children's education or into buying better seeds for the farm.
So when you provide the water tap and the solid roof, you are essentially buying back time and capital for the entire rural workforce.
You're moving them from what the source calls survival mode to productive mode, and you see the result in the macro data. The World Bank data cited shows extreme poverty, by their standard, is down to 5.3% in 2022-23. That suggests the baseline has fundamentally shifted. We're not just keeping people alive anymore, we're preparing them to actually enter the modern market.
And that seems to lead to the final pillar of this rural section, social capital. The partnership aspect you mentioned at the start. The sources talk about day NRLM and the self-help groups, which we've discussed before. But then it mentions apps, like Mary Panchayat, Andy Graham Swaraj.
This is the digitization of grassroots democracy.
How so? What did these apps actually do?
They enable participatory budgeting. In the old model, a chunk of money came from the state capital, it would vanish into the local council, and maybe a road got built, maybe it didn't. You had no visibility.
It was a black box.
A total black box. Now you have apps where any villager with a smartphone can see the budget allocated to their panchayat. They can track the progress of specific projects. They can upload photos of a poorly built road.
So it creates transparency, which creates accountability.
And accountability creates a stronger fiscal base. The documents mention another application called Samarth, which is specifically for tax collection. If a village can efficiently collect its own property taxes, which is suddenly possible because now they know who owns what, thanks to the drone survey.
It all connects back.
It all connects. If they can collect their own revenue, they have their own budget. They don't have to go hat in hand to the state government to ask for money to fix a streetlight. That is the beginning of true fiscal autonomy.
Okay, so just to recap this section, we have a rural base that is now documented, connected, healthier, and starting to organize itself financially and politically. That's the foundation.
In a much, much stronger foundation than it was a decade ago.
So now I want to pivot to the accelerator.
Mm-hmm.
The part of the economy that is supposed to make everything go faster, be more efficient, the AI ecosystem.
The pivot, and this is where it gets really complex.
Yeah, and what I really appreciate about this source material is that it's not just hype. It doesn't just say AI is the future, it will solve everything.
Yeah.
It's very sober. It lays out a series of what it calls strategic trade-offs. The document literally has a chart called The Four Great Trade-Offs.
Which is such a mature way to look at it, because public policy is always about choosing your pain. You can't have everything at once. You have to make tough choices.
So let's go through these, because the choices made here will really determine the shape of the economy for decades. The first one is scale versus inclusion.
This is the classic automation dilemma, but on a massive national scale.
The tension between getting things done as fast and cheap as possible versus keeping as many people as possible employed.
Right. So if your only goal is maximum scale and productivity, you deploy AI that automates everything it can. You replace the call center worker with a chatbot. You replace the paralegal sifting through documents with an algorithm. Your GDP per capita on paper goes up, but your employment figures might completely crash.
So that's the scale side of the equation. What does the inclusion side look like?
The inclusion side, as the source defines it, means prioritizing labor augmentation. You deliberately design and deploy AI that makes the human worker better, not obsolete.
Okay, give me an example.
So instead of replacing the nurse in a primary health center, you give that nurse an AI-powered tablet that helps her diagnose common illnesses faster and more accurately. She is still employed, she's still providing the human touch, but she's more productive, she can see more patients, her skills have been augmented.
But that path is slower, isn't it? It's less
Room.
ruthlessly efficient.
It's harder. It's definitely slower. It requires massive investment in training. It requires designing interfaces for people with varying levels of literacy. But the argument in the source is that this is the necessary path for a country like India. We have a massive labor surplus. We simply cannot afford a technological revolution that just deletes tens of millions of jobs.
Okay, trade-off number 2. Proprietary versus open. This feels like the walled gardens of big tech versus the public parks of open source.
That's a perfect analogy, and this is all about where the innovation comes from and who benefits from it. A proprietary model, think of the big AI labs in the US, incentivizes massive private investment. A company will spend $10 billion developing a new model because they know they will own the code, they will own the IP, and they will reap the profits.
And if they have to just give it all away for free, they're not going to spend that $10 billion in the first place.
Exactly. That's the argument for proprietary systems. But the downside is, if that cutting-edge code is locked up inside a corporate vault, how does a startup in Jaipur use it to build a new app? How does a student in Kochi learn from it and improve it? They can't.
They're locked out.
They're locked out. So the open model argues for shared innovation. The source uses the word diffusion. How quickly can the benefits of this technology diffuse through the entire economy? Open models are much better for that.
So the trade-off is, do we want a few super powerful, globally competitive AI companies that hoard the benefits? Or do we want a broad, vibrant ecosystem of smaller innovators who are all building on shared public tools, even if those tools aren't quite as powerful as the proprietary ones?
And the source seems to suggest we need a mix, a sandwiched approach. We need the big players to push the frontier, but we need enough openness so that the entire economy doesn't get held hostage by a few monopolistic rent seekers.
This leads into the third trade-off. Data center scale versus local compute. Now, this sounds very technical, but break down why this matters for the economy.
It matters because of where the power, both computing power and economic power, is located. The dominant trend right now globally is toward these massive large language models. And to train and run these, you need data centers the size of several football fields. They consume gigawatts of power. Only a handful of entities on the planet can afford to build and run them.
So it naturally leads to centralization.
Yeah.
A few brains in a jar that everyone has to plug into.
Exactly. And those jars are mostly located in California or Virginia. The alternative path is what the source calls local compute, or developing small models. This means creating AI that is incredibly efficient enough to run on a local server, a laptop, or even a high-end smartphone.
This is distributed efficiency.
Distributed efficiency. It's cheaper, it's more resilient, it's better for user privacy because the data doesn't have to travel to a central server, and critically, it works in places where internet connectivity is spotty or non-existent. For an economy like ours, with so many remote and rural areas, betting everything on a centralized cloud model based in a few big cities is a very risky strategy.
Okay, the fourth and final trade-off. Regulation versus innovation. The classic dilemma.
Speed versus safety. Go too fast, you break things. Go too slow, you get left behind. If you wrap the entire AI sector in heavy red tape demanding years of audits and approvals for every new algorithm, you will kill the boom. Startups will die or move elsewhere.
But if you have zero regulation, the move fast and break things approach.
You risk chaos. You risk deepfakes destroying social trust, algorithmic bias entrenching discrimination, financial markets being manipulated. It's an incredibly fine line to walk.
A real tightrope. But amidst all these difficult trade-offs, the source identifies one clear, massive advantage that India has. And it's not capital, it's not chips, it's data. But it refers to data in a very specific way, as a strategic resource.
This is where the strategy document gets really, really interesting. It moves beyond the cliches. It's not just, oh, we have lots of people, so we have lots of data. It's reframing that data as the fundamental raw material for the next industrial revolution.
We have roughly 1 billion connected people generating what the source calls human-generated data every single day.
And the key strategic imperative that the document highlights is to retain domestic value. Those 3 words are critical.
Unpack that for us. What does it actually mean to retain the value of data.
Okay, think of it like this. Think of data as the new crude oil. In the 20th century, many developing nations had huge reserves of crude oil. They would extract it from the ground and export it as raw crude to the developed nations.
Okay.
Those developed nations would then take the crude oil, refine it into high-value products like gasoline, diesel, plastics, and pharmaceuticals, and then sell those finished goods back to the developing world at a massive profit. The country with the raw material made pennies on the barrel. The country with the refineries made hundreds of dollars.
And you're saying we are at risk of letting that exact same pattern repeat itself with data.
We are in grave danger of it. If we just allow all of our healthcare data, our linguistic data, our traffic pattern data, our consumer data to be piped to servers in Silicon Valley, what happens? They use it to train their sophisticated AI models, and then they sell us access to that intelligence as a subscription service. We become a digital colony. We provide the raw material for free and then pay to import the finished product.
So how do we stop that? How do we build a refinery here at home?
We refine it here. The source is very explicit about this. It talks about using our own domestic data to train sector-specific models tailored for India's unique challenges.
Give me a concrete example of that.
Healthcare is the perfect one. An AI model trained primarily on American medical records will be an expert on diseases and conditions prevalent in that population, obesity, certain types of heart disease. But it might know very little about tropical diseases like dengue or malaria or genetic conditions that are specific to the Indian subcontinent.
So it would be less useful for an Indian doctor.
Potentially much less useful. But if we take our own vast, diverse health data and use it to train a local AI model, we can build a tool that helps our doctors solve our problems. And critically, we own the intellectual property. We can even export that solution to other countries in the global south with similar challenges.
The source mentions a clever mechanism for encouraging this, called menu-based compliance. It sounds like you're ordering lunch at a restaurant.
It's essentially a sophisticated negotiation tactic. It's the government saying to the big global tech companies, you want access to our billion-person market. You want to use our data to improve your models, fine. But it's not a free-for-all. You have to pick an option from this menu.
And what's on the menu?
The menu has things like, you must make a significant financial contribution to a domestic AI research fund. Or you must set up a world-class training program for 10,000 Indian engineers. Or you must open source some of your older models for our startups to use.
So it's a toll booth, but the toll isn't paid in cash to the government. It's paid in capacity building for the nation.
Exactly. It's leveraging our market size to force a technology transfer and build our own domestic ecosystem. It's very strategic.
Which brings us, naturally, to the people. The people who have to actually do this work, who have to use these tools, the human capital section of our analysis. Because if we have drones in the villages and AI in the cloud, we need a workforce that isn't obsolete.
This is the bridge that connects the foundation to the accelerator.
And the source suggests a pivot in education that, honestly, it surprised me. Usually when we talk about preparing for the AI era, the advice is pretty standard. Learn to code. Everyone needs to become a computer scientist.
And this set of reports says, not necessarily. In fact, for many people, maybe not at all.
It talks about redefining high skill and looking beyond white collar. This feels very counterintuitive.
It is, until you think about Moravec's paradox. It's a long-standing principle in AI research that says things that are intellectually hard for humans, like advanced calculus or analyzing a billion rows on a spreadsheet, are actually pretty easy for AI. But things that are trivially easy for humans, like folding laundry, fixing a leaky pipe, or calming a crying toddler, are incredibly mind-bogglingly hard for robots and AI.
So the cognitive stuff, the traditional white-collar knowledge work, is actually the most vulnerable to being automated.
In many ways, yes. An AI can write a legal brief or a market analysis report faster and often better than a human junior associate. But it cannot physically fix a complex machine on a factory floor. It can't cook a delicious meal with creative flair. It can't nurse an elderly patient with genuine empathy. So the source highlights the urgent need to fill gaps in what it calls high-skill, human-centric jobs.
The examples listed are fantastic because they're so unexpected. High school metalwork, early childhood education, culinary arts.
I love the metalwork example. For decades, we've kind of looked down on vocational skills like that. We've pushed everyone towards a university degree. But in an AI-driven economy, a skilled welder or master machinist is incredibly robust. They're solving complex 3D spatial problems in real time. They're working with their hands and adapting to unexpected material imperfections. That requires a level of dexterity and intuition that robots are decades, if not centuries, away from achieving.
So the economy of the future needs to place a much higher premium on experiential expertise, not just theoretical knowledge.
Yes, and that requires a new educational pathway, as the source calls it. Flexible, credit-bearing vocational courses that start in high school, not as an afterthought. You don't just sit in a classroom memorizing formulas. You go out into a workshop, you build things, you work with your hands.
You create an adaptive workforce.
Exactly. The new rule is simple. If your entire job can be done by sitting in a chair and looking at a screen, you should be worried. If your job requires you to move around in the physical world and interact with unpredictable objects and people, you have a much greater degree of job security.
Okay, so let's take stock of where we are. We've rebooted the village, giving people property rights and new tech tools. We've negotiated a strategic AI deal to keep the value of our data at home. We've started retraining our kids to be metal workers and caregivers instead of just coders. Now for the big question. Where does everyone live and work?
The cities.
This brings us to Section 4, urbanization. The source calls this the productivity engine. But man, looking at the data they present, that engine is smoking, it's misfiring badly.
It's sputtering, and this is the great physical reality check. You can have all the brilliant digital strategies and educational reforms you want, but the economy ultimately happens in physical space. People need a place to live, a way to get to work.
The source starts with a concept from economics called agglomeration economies. Break that down for us. What is that?
It's a fancy term for a very simple idea. People and companies are more productive when they are physically close to other people and companies.
The water cooler effect, but for a whole city.
On a massive scale, it creates efficient matching. If you are a highly specialized software engineer, you move to the city because that's where all the tech firms are. If you're a tech firm, you set up in the city because that's where all the talent is. You share infrastructure, airports, power grids, and most importantly, you get what economists call knowledge spillovers, ideas that jump from person to person in cafes, in meeting rooms, even on the metro. Cities are the physical platforms for innovation.
But then we immediately crash into what the source called the density problem. And this is where I want to spend a moment on this one variable, FSI, the floor space index. There's a graph in this report comparing India's major cities to the world, and it is just jaw-dropping.
It is one of the single most important graphs for understanding India's economic future, in my opinion.
So on one side of the graph, you have these global giants, New York, Tokyo, Singapore, Hong Kong. Their FSI bars are huge. They build tall, they build dense. On the other side, you have Mumbai, Delhi, Bangalore. And the bars showing their free FSI are tiny. They're stumps.
It's a complete paradox. We all think of our cities as incredibly crowded. We feel the crowd on the street, in the train, but we have very high human density, a lot of people packed into each square kilometer, but we have astonishingly low built density.
Explain FSI like I'm 5. What is it?
Okay, imagine you have a plot of land that is 1,000 square feet. If the government sets the FSI at 1, it means you are legally allowed to build a total of 1,000 square feet of building on that plot. You could build a single-story building that covers the whole plot or a two-story building that covers half the plot.
Got it.
Now, in a place like Manhattan, the FSI in some areas might be 15 or even higher. On that same 1,000 square foot plot, you could build a 15-story building. In many Indian cities, for decades, the FSI has been legally capped at 1.5 or 2 or maybe 2.5. We are literally, by law, forbidden from building up.
But why? What was the logic behind keeping our buildings so short?
The official argument for a long time was that our urban infrastructure, our sewage pipes, our water mains, our roads, couldn't handle the load from high-density buildings. The fear was, if we let them build tall towers, the pipes will burst and the roads will be permanently gridlocked.
Which, on the surface, sounds kind of reasonable.
It sounds reasonable, but it has backfired spectacularly because the people don't just disappear because you can't build a tower for them to live in. The jobs are in the city, so they still come. But since they can't afford to live in a tall apartment building in the city center, because it doesn't exist, they are forced to live in a short building very, very far away in the suburbs.
It's the pancake effect. The city can't grow up, so it just spreads out.
Exactly. The city spreads out like a pancake, getting thinner and thinner at the edges. We call it urban sprawl. And here's the irony. Sprawl is actually far more expensive and inefficient to service with infrastructure than density is. You have to run pipes and power lines for miles and miles to reach those far-flung houses, and worst of all,
The commute.
the endless, soul-crushing commute.
This leads directly to the next section in the source, which they call the mobility tax. And the data here is just painful to read.
They've calculated the rush hour time lost per commuter per year. For Bengaluru, 117 hours.
Okay.
Mumbai, 103 hours. New Delhi, 76 hours.
Let's just pause on that Bengaluru number. 117 hours. That is nearly 3 full 40-hour work weeks. Imagine sitting down at your desk on January 1st and doing nothing but staring at a wall until January 21st. That is the amount of productive time the average commuter in that city is throwing away every single year just sitting in traffic.
That is millions and millions of productive hours just vanished. And it's not just the lost time, is it? It's the fuel cost, the pollution, the stress, the impact on health.
It completely breaks the agglomeration benefit we just talked about. If it takes you 2 hours to get to a potential business meeting across town, you know what? You don't go to the meeting. You do a Zoom call instead. The spillover of ideas, the spontaneous innovation, it all stops. The city stops functioning as a single unified market and breaks apart into these little fragmented islands.
The solutions proposed in the document are interesting. It's not just the simplistic build more flyovers.
Because we know that just building more roads usually induces more traffic. It's a losing game. The source talks about smarter solutions, digitizing bus fleets so you know exactly when the next bus is coming, finance first e-bus deployment to clean up the air.
And then there's the really controversial one, congestion pricing.
The really controversial but highly effective one, charging people a fee to drive their private cars into the most congested parts of the city during peak hours. It's been a game changer in London and Singapore.
And transit-oriented development, or TOD.
Which brings us right back to FSI. TOD is the simple, brilliant idea of building very dense, tall, mixed-use buildings right on top of and around metro stations. You create neighborhoods where people can live, work, and shop all without ever needing to get in a car. But you simply cannot do TOD if the law says you can only build 3 stories high next to the metro.
So it all comes back to unlocking the land. The source explicitly calls for unlocking land productivity and mentions Buhadhar for urban land titling.
It's the same principle as in the village. You can't build a 30-story building on a plot of land if you don't have a clear, undisputed, digitized title for who owns the dirt underneath it.
Now, whenever we have this conversation about fixing our cities, fixing the trash, the traffic, the rules people get very cynical. They say, oh, this is India, we're chaotic by nature, it's our culture, it will never change. But the source material throws this massive, optimistic curveball into the discussion, the Indore case study.
This is the civic economics lesson, and it's so important.
Indore has been named India's cleanest city for several years running, but the source includes the before picture. In 2014-15, door-to-door waste collection was negligible, basically zero. It was like any other city.
A standard, struggling Indian city with overflowing bins.
By 2024-25, that door-to-door collection covers 98% of the city's wards. Waste processing went from 16% to 80%. I mean, how? How did they flip the script so completely, so fast?
It wasn't magic, and it wasn't some sudden cultural awakening. It was a very deliberate mix of modern technology and smart psychology.
Okay, the tech part we can understand. GPS-enabled garbage trucks.
Command and control centers. They had a live map of the city, and they knew where every single truck was at every moment. If a truck missed a particular lane, the map showed a red line, and the manager in the control room would call the driver and send them back. It was about creating total accountability in the system.
But what about the psychology part? The source mentions Nukat Nataks, or street plays, oath-taking ceremonies by students, even mobilizing religious leaders to talk about cleanliness in their sermons.
They attacked a behavior. They didn't just put up signs. They made cleanliness a matter of social pride, a civic duty, almost a moral quest for the entire city. But there's a deeper economic lesson here that the source points out, and it's this phrase, rule certainty over rule proliferation.
That sounds like a great catchphrase, but what does it actually mean in practice?
It means that governments, ours included, love to make new rules. Don't spit here, don't litter there, don't honk. We have a million rules written down somewhere, but nobody enforces them consistently. And when you have rule proliferation but zero enforcement, you get chaos and cynicism.
You get the broken windows effect. Everyone else is dumping their trash on this corner, so I will too. Why should I be the only one to follow the rule?
Exactly. Indore's genius wasn't just making a rule, it was creating rule certainty. The garbage truck will come to your door every morning between 8 and 9 a.m. If you dump your trash on the street, you will be caught and fined. When the system becomes that reliable and predictable, the citizen becomes compliant. It's human nature.
So civic sense isn't some magical genetic trait that some societies have and others don't. It's a rational response to a well-functioning system.
100%. And an orderly city is an economically efficient city. If people follow traffic lanes, traffic moves faster. If people reliably separate their waste, the city's health costs go down and it can generate revenue from recycling. Indoor proves that you can, in fact, engineer civic sense.
The final concept in this urban section is about future cities, and it has this beautiful, simple quote, "Time as the central urban resource."
I love that. It completely changes the metric for success. Usually, urban planners measure success in kilometers of road built or tons of concrete poured. This is no, the only metric that matters is the citizen's time. A good city gives you time back. A bad city steals it from you every day.
And it also talks about the integration of informality.
This is so crucial for our context. We are not Singapore or Zurich. A huge part of our urban economy is informal. We have street vendors, we have informal markets. The old model of city planning was just to bulldoze them and build a glass building. This new thinking says we should integrate them, design for them. That creative density, that supposed chaos of the street market, is actually where a huge amount of economic transaction and social life happens. We need to design for our reality, not some imported Western fantasy of a city.
So we have covered a lot of ground here, from drone pilots in villages to FSI and megacities. Let's try to pull this all together in a final synthesis. We started with the premise of convergence.
The three-legged stool, the tripod.
Right. So leg one, the rural reboot. What's the takeaway?
The takeaway is shifting from welfare to assets. It's about digitizing the land with schemes like SMOMTIV so it has real economic value, and then layering technology like the drone DDoS on top to create a skilled, productive workforce that isn't trapped in daily survival mode. It's about building a solid foundation.
Okay. Leg two, the AI accelerator.
This is about using AI as a powerful efficiency layer across the entire economy, but being smart and strategic about it. It means keeping the value from our data domestically, building our own refineries, not just exporting the crude oil, and critically prioritizing labor augmentation so we don't create a social crisis by leaving the bulk of the workforce behind.
And finally, leg three, the urban container.
This is the physical platform where the high-value parts of the economy live and breathe. And to make it work, we have to solve the density paradox by fixing FSI to stop the endless sprawl, and we have to solve the mobility tax so that people can actually connect, interact, and innovate efficiently.
And if you get all three of those legs right,
Then you get a truly unified economic engine. You get that fundamental shift we talked about at the start from participation, where people are just passive recipients dragging along, to partnership, where every citizen, from the drone pilot in the village to the metal worker in the city, is an active, empowered asset creator in the economy.
before we sign off, I want to leave our listeners with one final thought. The source we looked at mentioned cities that inspire imagination. And we talked a lot about valuing human-centric skills.
Yes.
And it just strikes me that we spend so much time obsessed with the hard numbers of economics. GDP growth, inflation rates, fiscal deficits, pure efficiency. But looking at the indoor story, where street plays and social pride help clean a city, and the metalwork story, where hands-on craftsmanship is being revalued as the future, it just makes me wonder,
That's the wonder.
is the ultimate economic unlock, the thing we're missing, actually, psychological? Think about it. If we design cities that are clean and beautiful and that value our time, we feel respected as citizens. If we design an education system that values craftsmanship and hands-on skill, people feel a sense of pride in their work. If you give a villager a formal property card for the land his family has lived on for generations, they finally feel like an owner, not just an occupant.
It's about dignity.
It's all about dignity. Do we create an economy that is not just more efficient, but vastly more resilient to the very AI-driven changes we discussed, because it's built on a foundation of human dignity and self-worth? If the machine takes over all the pure logic and calculation, maybe the only truly durable economic value left is our humanity itself.
That's a profound thought to end on. If the machine takes the IQ, the economy has to run on EQ. And our physical environment, our cities, our schools have to be designed to nurture that emotional and social intelligence. I think you're right, the so-called soft stuff is actually the hardest and in the long run, the most valuable stuff of all.
Something for all of you to mull over on your commute, a commute that hopefully is getting shorter and shorter. Thanks for taking the deep dive with us.
See you next time.